It's 9 a.m. here in New York City. I'm Shauna Smith alongside Jared Blickery, and this is Yahoo Finance Live. Here's what we're watching this morning. Well, he is back. Sam Altman is reinstated as CEO of OpenAI less than a week after his shock ousting. Now, OpenAI's board also having some new faces. What does this return mean for the startup? Also, what does it mean for Microsoft and the future of artificial intelligence?
Plus, another quarter, another blowout from Nvidia. Company saw record revenue in its fourth quarter, but warned of negative impacts from China restrictions. Shares sank after the bell. The stock now rising in the pre-market, as you can see on your screen.
And Nvidia, of course, the top performer in the S&P for 2023, soaring over 200% year to date and bringing the S&P to record levels. A growing band of Wall Street strategists predicting we're only going up from here. And another big story that we're watching, it's a blow to the crypto world. Binance's CZ stepping down as CEO after pleading guilty to money laundering violations here in the U.S. The leading crypto exchange also agreeing to pay more than $4 billion in fines.
Our top story today, Sam Altman, once again back at the helm of OpenAI after a tumultuous week. That didn't take long. Company's new initial board will not have 3 of the 4 board members that were involved in Altman's removal. And now it's going to include former co-CEO of Salesforce, Bret Taylor, and Larry Summers. He's the former Treasury Secretary of the United States. Following the announcement, Altman took to X to write in part, "I love OpenAI, and everything I've done over the past few days has been in service of keeping this team and its mission together." And Sean, this is a story, I think, this may not seem like the biggest story of the year. I think in 10 years from now, we're going to say, oh, that was the biggest story of 2023. People are going to remember this. It's going to be studied at business school. I think it's a coup for Microsoft because it was not a fait accompli that they would get to participate in ChatGPT-5 if it has true artificial general intelligence. Now they have flexed and shown that they are partners with Sam Altman wherever he goes. So I think this is a big win for them.
Yeah, exactly. We also heard a similar sentiment from Rishi Jaluria earlier this week of RBC. He called it exactly that in terms of it was a win here from Microsoft, just how close that relationship is specifically with Sam Altman. Obviously, we know the multi-billion-dollar investment that Microsoft has made in OpenAI. What really sticks out to me about this announcement, other than the fact that Sam Altman is back as CEO, is the changes that we have seen to the board, at least right now, this initial board, including, like you said, Bret Taylor, who's a former CEO, co-CEO of Salesforce, and then the former Treasury Secretary, Larry Summers. I mean, you talk about what exactly this could mean for OpenAI going forward and maybe where some of the priorities could lie. We know that Summers sits on the board of a number of companies, including Block, so he certainly has obviously the experience there. Taylor right now is a director at Shopify. There are reports right now from Bloomberg that the reworked OpenAI board is not final right now, and the main priority is to set up 9 new directors. So I think, of course, the question is just Microsoft's role in all this and whether or not they are going to have some representation on the board.
You bet, Sean. And let's bring in, we want to continue talking about this. We're going to bring in Dan Ives. He is a Wedbush Managing Director and Senior Equity Analyst joining us now. Dan, you've been listening to our banter here about Microsoft, OpenAI, Sam Altman's departure and return. What's your big picture take about all of this?
Look, I think the clown show that was the OpenAI board, they're gone. And now adults are in the room. And from Microsoft, it's a champagne moment because they're in a better position than they were before this with the circus show board gone. And now you have Summers, Taylor, and probably others that are going to come on the board, potentially including Microsoft. And I think that's really the key to the stock, is that they are in a firmer position than when this whole twilight zone started.
Dan, when it comes to the future of this company, Satya Nadella tweeted out, put a post on X yesterday shortly after these moves were announcing that this is the first essential step here in terms of the restructuring or reworking that we're seeing take place at OpenAI. When you look down the road and Microsoft's involvement here, I guess, do you expect to see more profound changes at OpenAI? And what are you hoping to see some of those changes look like as an analyst here for Microsoft?
Yeah, it's a great question. Look, I think Nadella, if you look at really what happened here, I mean, this is a 4-person board that almost was going to take down a $90 billion company, right? They were essentially kids playing checkers at the kids' table Thanksgiving. Nadella, the grandmaster chess wizard, came in and basically resolved that. Because when you look at OpenAI and Altman, this is the global face, the golden child of AI. That combined with Microsoft Look at Nvidia in terms of what we saw last night. This is biggest tech transformation in 30 years. Microsoft's leading it. The last thing they could have happened is Altman goes free agent to Amazon, Google, or others. That's why right now I think Nadella is sleeping well, drinking his coffee.
Dan, I want to ask you about some of Sam's other ambitions here. I think that it's clear that the road has been paved for him to just go ahead with the for-profit initiatives that were causing some of the risk. But in the past, he sought billions of dollars from Middle East sovereign wealth funds. He wanted to form an AI chip company that would compete with the likes of Nvidia. He's had ambitions going with SoftBank, partnering with Masayoshi Son for multi-billion-dollar investment in AI-oriented hardware. I'm wondering, does this kind of green light those ambitions, and where else are we going to see Sam coming into play here?
All of the above. I mean, because now that the clowns are out in the board, it's a green light. And I think, especially from a chip perspective, from Microsoft, this is Goldilocks. Because they never wanted everyone to come over to Microsoft. That was basically just a poker move. Now things are almost stronger position with better governance. And I think now it's all the above. Chips, they're going to go full force. And from Microsoft, that's why, I believe this is on its cusp, toward what I believe over the next year hitting 4 trillion.
All right, Dan, stick with us here because we're talking a lot about AI. We got to talk about the leader in this space, certainly on the move this morning. It was another blockbuster quarter from Nvidia after the bell last night, another blowout quarter. Revenue soaring over 200% in the third quarter from last year. There is some concern, though, just about the impact of export restrictions, and that's giving investors a bit of pause here this morning. We did see the stock initially sank just about 6% on the heels of the report in aftermarket trading. Right now, ahead of the open, we're up just about 0.3%. Dan, when you take a look at these results here that we got from Nvidia, what does this signal just in terms of their position? And it almost seems like nothing is stopping this company anytime soon.
I mean, the godfather of AI, Jensen, the Don Corleone of AI, yet again, that's what the street's focused on. Another $2 billion beat. It shows that this AI gold rush is as real as we've ever seen from a monetization perspective. And this is one, not just in terms of Nvidia, in terms of where I believe the stock continues to head up and to the right. It's what it means for broader tech. This shows monetization is now here. Use cases are exploding. The China worries were really essentially overblown, I think, contained. And that's why I think this morning the bears go back into their dark caves hibernation mode.
Dan, can we just touch on China for a second? You mentioned the fears being overblown. The company, Nvidia, estimates that 20 to 25% of their sales in the data center are affected by this. But as I understand, Nvidia is able to tweak their product offerings to comply with the changing regulations in fairly creative ways. Can we or can investors count on that continuing into the future? And is that really the only strategy they have, or are there other things in the mix?
I mean, they have other things they could pull out of their pocket, but that's why, okay, is this an issue? Yeah, they called it out on the conference call, but I think much more contained than maybe worries. And that's why I think if you look at some of the headlines over the last month or two, you always have to sort of, I think, be weird, because these companies, the Nadellas, the Jensens, okay, the Cooks, 3 steps ahead in terms of where this is all going. And this is just another phenomenal poker move for Nvidia, and that's why this is a stock, in our opinion, probably heading towards 600.
Dan, Nvidia, though, has also made itself a bit of a target here. When you take a look at the success that they have had in selling their AI chips, we've seen Microsoft unveil its in-house AI processor last week. Amazon's AWS, a similar move here. AMD set to roll out a competitor soon. Do you see that at all denting demand down the road? And how much of that, if at all, has been priced into the stock at this point?
Look, as you get into 25, 26, 27, you have other chips that will come through. But for right now, I mean, they are the only game in town. And I think that's really the focus here when it comes to AI. Those GPUs are essentially gold. And I think that's the important thing, because that's driving the AI revolution that, in our opinion, has begun the new tech bull market.
Dan, just thinking about Nvidia's reach here, you were saying they're the only game in town effectively. Have they been able to just do away with the cyclicality of the chip cycle? How long can these steady profits, the beat and a raise, continue? I guess the final question is, the ultimate question is, what's the TAM of this AI market? Has anybody figured that out yet?
I mean, we've talked about $1 trillion incremental in terms of AI over the next decade. That could be conservative. And that's why right now, I mean, Jensen's drinking a mimosa, because this is just, it's really their world. Everyone else is paying rent when it comes to AI.
So Dan, what does the upside look like from Nvidia between here and maybe a year from now, the 12-month price target?
I mean, look, it's Wedbush, 600 price target has been our view. But I think the most important thing, it's not just about Nvidia. It's about what this is about Microsoft, Google, Palantir, the Messi of AI, and I think Datadog, MongoDB. This has begun now. The shores of tech are going to see, what I view as a 1995 moment, anything we've seen since the start of the internet.
All right, Dan, we got to leave it there. Always great to have you. Dan Ives, Wedbush Managing Director and Senior Equity Analyst. Founder of Binance, CZ, pleading guilty to money laundering violations in another stunning blow to the crypto industry. As part of his guilty plea, Zhao agreed to pay a $50 million fine and step down as the company's CEO. Zhao is one of the most powerful and influential figures in the industry. So what comes next for Binance and the industry? What tasks at hand are for the company's new head, Richard Teng? Let's bring in now Yahoo Finance's David Hollerith to explain. David, the details, please.
Jared, so now that we have this legal pact with U.S. authorities, Binance is going to be playing, what we could say compliance catch up in a big way. It has about 3 years of transactions, worth about several trillions of dollars in terms of customer volume that it needs to go back through. Previously, part of these fines were that the company did not file suspicious activity reports. And it's got to go back and do that. And that's going to take a lot of time. And these reports are expected to lead to other investigations, which could complicate things for the firm if more illicit activity on their part is revealed. Could also make matters worse for the customers if any of the customers were also engaged in illicit activity. The pact also that we saw yesterday didn't include or end Binance's legal troubles with the SEC. They are currently in a civil lawsuit with the SEC that came out back in June, alleging that Binance violated investor securities laws, mishandled customer funds, and that matter is still at hand in court. Finally, this $4 billion fine that Binance has agreed to pay, based on analysis, third-party analysis from actually a director at Coinbase, it does appear, just based on what can be seen through the blockchain, that Binance does have enough money to pay this. So for the, in the short term, they are okay, and they will not need to make any additional crypto sales, which is important for the market. But, I think largely looking forward under this new CEO, Richard Teng, who we haven't really heard from yet. He did make a statement yesterday, but, reporters, myself including, are very interested to speak with him. He's going to need to sort of prove in the coming weeks that Binance can continue, its business model can continue to work now that it is playing by the full rules of money laundering and sanctions laws under the U.S. jurisdiction. And so we're going to want to watch to see that and pay a lot of attention to Binance's market share. It was once held the majority of crypto market activity in the past. And now we're really going to want to see if that's going to continue to shrink as it has in the past couple of months.
All right, Dan Holler, thanks so much for the latest on that. Certainly a story we will continue to watch. Let's get to a mover here this morning. A slowdown in demand for farm equipment is hurting the world's largest tractor maker, Deere, warning that it expects a decline in sales of tractors, crop harvesters, and other equipment. Farmers have enjoyed a boost in income from higher prices for crops and livestock and used those earnings to invest in new equipment from Deere, but sliding crop prices are leading to a pullback in those sales. We've seen Deere lose some of its momentum. Shares falling this morning on the guidance that we got here from the company. You're looking at a drop of just about 5%. And digging a little bit deeper into these results here in terms of that guidance, Deere now seeing net income for 2024 of $7.75 billion to $8.25 billion. That was far short of what the street was looking for, of just over $9 billion. They are seeing sales declines of roughly about 10% across their three businesses, certainly setting up to be a challenging time here for the company.
Yeah, and I think it's important to note that the cyclicality of the business cycle that we have in the U.S. Is not necessarily tied to the agricultural cycle. We have El Nino going on this year that has its own issues, and I'll just read some analyst commentary and then I'll go to the charts. In fact, well, let's go to the charts right now. This is more exciting, right? So Deere down about 5% in the pre-market. This is, the background is colored as of yesterday, but I'm going to put the year-to-date totals in here and remove those pre-market quotes so we can really see what's going on. In a year where we're having gangbuster rises in the S&P 500 and to a lesser effect certain other indices, NASDAQ outperforming, we haven't seen that in this space. And especially over the last month where things have kind of broadened out, we're still seeing some green here, but not a lot of dark green, not a lot of outsized profits. So just kind of gives you an idea of what's happening. This is Deere year to date, and you can see a lot of choppy price action there. Over the last 3 years, actually, let me change this to a 5. You can see the run up that we had in the early pandemic through the election into 2021. And then it's just been this kind of slow, steady slog sideways to up action ever since. That's healthy in the secular term, even though we haven't necessarily seen those profits in the short term, or I should say the returns in the short term. I do have some notes here. Baird analysts, they rate the stock and outperform with a price target of 445, saying investors have been anticipating a decline in fiscal 2024, and the guidance makes it official, with Deere pointing to double-digit declines in large ag and continued selling pressure in small ag. So just a little bit of bearishness there. Interesting to analyze these pockets of the market that aren't necessarily correlated to the Magnificent Seven and everything we talk about every single day.
Diversifying it just a bit, you know?
Diversity.
Yeah, exactly. So some pressure here this morning, but like we said, the momentum has been very strong. When you take a look, at least for their Q4 results, pretty much better than expected across the board.
Yeah,
Q3 results, excuse me.
And it's always about that forward guidance. Well, crude oil prices, they are tumbling today as we learn a critical OPEC Plus meeting has been delayed. It comes as Goldman Sachs was predicting a 35% chance of additional OPEC Plus output cuts. And for more on this, we bring in Yahoo Finance's Ines Ferre. Ines, what are the details? I was hoping for some OPEC action in the short term.
Yeah, that's right. Well, we had some action over the last couple of sessions, but really, this is a surprise for the markets and why you're seeing oil take another leg lower, even though oil had been lower today before this announcement was made. But look, I reached out to an analyst that told me OPEC likes to have consensus before its meeting takes place. So this may be a signal to the markets. And what you're seeing with the oil prices today is that there isn't necessarily consensus on what OPEC will be doing next. Now, the expectation from traders was that OPEC Plus would be announcing after its meeting that it would extend its production cuts into next year. That was expected. There was a 50-50 expectation from traders that OPEC Plus would actually deepen those production cuts. And what you saw with oil prices going into today, for example, ahead of the meeting that was expected for Sunday, one analyst was saying that if OPEC Plus didn't actually deepen those cuts, you would see the markets go lower, because right now you've got the supply-demand picture showing where the prices are at. So it could be that OPEC isn't agreeing among its members on what to do next. There could be disagreement there. They could also be seeing some fundamentals in the oil markets, which is making them pause as far as what they would be doing next. Nonetheless, look, the prices, as you're showing on our Wi-Fi Interactive board, they are down about 18% from their peak in September. You also do have have some stop losses going on there, some technicals that have been taking place over the last couple of weeks. But the increasing rhetoric has been about supply and what's been happening with supply. We've been seeing supply inventories up in the US. We also are now getting some data on Europe and shipments that are going to Europe and those shipments that are building there in Europe. We've got some government data from the US that's supposed to come out today to talk about, to seeing where the supply is at. But supply is expected to be increasing. It has been increasing. And looking into 2024, analysts are expecting that the non-OPEC plus members are going to be increasing their supply as well. So even if you do see a resilient economy, even if you do see demand ticking higher, you still will see an uptick in supply as well. So that bodes for oil prices. JP Morgan the other day is saying that oil prices would be around $83 for Brent next year. We'll see what happens after OPEC Plus does have their meeting on the 30th now.
And that's just in terms of the reaction that we're seeing play out in the market here this morning with oil prices crude off just about 4%. Is that a bit of an overreaction given the scenario that you just played out? Even if we do see OPEC Plus further their cuts, further their production, the fact that we will see supply coming online here in the U.S. and other parts of the U.S., maybe it's not obviously as big of a driver, something we have been talking about in the price of oil that it has been in the past.
Yeah, that's right. And I mean, what you're seeing even with the trend of oil coming down from its peak in September, you do see that there are concerns about demand going forward and the supply that's going up. But certainly what you're seeing, I mean, look, oil nonetheless tends to overreact with whatever is happening at the moment. But what it does signal, this move to the downside more than 4%, is perhaps the markets are anticipating that there won't be a deepening of cuts next year. Maybe they do roll over the current cuts that they have, but they won't deepen those cuts, and therefore they have to contend with the increasing supply in the market, and that's what's being reflected in what you're seeing now. But we'll have to see. Markets tend to overreact when these headlines come out.
We're looking at crude just below $75 a barrel. All right, Ines, thanks so much.
Thanks.
Keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
Well, what's more American than sitting around with family at the Thanksgiving table and talking about politics? The Biden administration continuing to tout the strength of the U.S. economy and the work Bidenomics has done to help voters. But what's the average American's take right now? Well, for those hitting the road this holiday weekend, gasoline prices are at the lowest level that we've seen of the year. But once folks sit down at the dinner table, they're going to find that food prices remain stubbornly high. According to the American Farm Bureau Federation, the average Thanksgiving plate is going to run Americans around $61 this year, 4.5% less than last year's historic high, but still a whopping 25% more than pre-pandemic levels. So what's going to be the takeaway this week and weekend, and Bidenomics' success here or lack thereof? We want to bring in Rick Newman, obviously, who better to talk to than all of this. And Rick, when you see what's playing out right now, gas prices and the price of food, obviously Americans still feeling a lot of pain on both fronts, even though we have seen gas prices come down quite a bit.
I think the verdict is in. Bidenomics is a flop. The country is just completely unhappy. Everybody's in a foul mood. I mean, confidence levels are basically at recessionary levels. And I think something that we figured out about the American psyche is that Americans don't feel better when prices go up and then come down a little bit. They're not saying, oh, well, thank goodness, something costs 4% less than it did last year. I think that there's this psychological thing where people think the right price for something is the lowest that they ever paid. And then if it's higher than that, everything's terrible. Gas prices got down to basically $2 a gallon during the COVID pandemic in 2020. I mean, that's when demand fell off a cliff. But they were in the twos for much of the Trump administration. And in the Biden presidency, they've been in the threes and, of course, in the fours in 2022. And people just think that's too high. I mean, gasoline prices are down by a lot. They're around $3.35, I think, right now. I think that's actually fine because people don't spend as much on gasoline as they think. It's only like 3% of the typical household budget. But it's these psychological factors. And the country's just in a foul mood. Sorry about that.
Oh, don't apologize at all. We're now less than a year away from the election, and kind of a big deal there. We talk about presidential cycles in the stock market, but just in general, what kind of jawboning and what kind of maneuvers might we see that are purely political over the next year?
You cannot jawbone American consumers into thinking that they are better off than they want to feel. You just can't do this. Obama learned this lesson during his first midterm election when Democrats got pummeled. And Obama kept saying, look at this great recovery we've had from the recession. And Americans were like, hey, things still stink. And there was a huge wipeout for Democrats that year. So Biden has a couple things going his way. Inflation is coming down. So that trend seems likely to continue. We're going to find out if we're going to have a recession in 2024. I mean, for what it's worth, 1 year ago, many economists were just sure we were going to have a recession in 2023. We didn't. So recession odds seem lower. So things are going Biden's way, but people have to feel it. They have to feel it in their budgets, and it's just not going to matter that the president tells them they should feel better.
Rick, what are the polling numbers telling us now? Because we certainly have seen the support here for Biden's slip. On the other front, when you take a look at the GOP, Trump has by far been the leader within that realm. Is there any reason to think that dynamic is going to shift?
That's the whole question for 2024. So polls show that people trust Trump on the economy over Biden by as much as 20 percentage points. Biden's approval rating is around 40%, and it's around 38% for his handling of the economy. I think for Biden to feel comfortable about his reelection odds, he wants his approval rating at 45%, between 45 and 50. I don't think there's any way he's going to get it over 50. But it would look better for him if he could get it up to 45, 46, 48. And it's possible, I guess. I mean, nothing's locked in stone a year away from an election, but people have to really change their attitudes about this economy.
All right, Rick, hold it right there. We just had the opening bell on Wall Street, and I want to get a quick check of the market here on the Wi-Fi Interactive. We have the Dow up about 34 basis points. You can see 119 points there. And let me just pull up what we have had this week. This is a three-day chart. We had green on Monday, some red on Tuesday, and green. So in festive form here, we are actually playing out the colors of the holidays. Looking at the NASDAQ, we are screaming higher, up 0.75%. The S&P 500 up about 45 basis points, 1% for the week. And I'm going to get a quick check on the bond market as well. 10-year T-note yield down another 2 basis points, 4.40%. Let's just remember that just a couple days ago it was above 4.5%. A few weeks ago, it was above 5%, Shauna.
All right. Well, one of the big debates of the year is the impact of rising rates on the housing market, that key cornerstone of the American dream. Now, the story is one of higher borrowing costs and a shortage of homes. It is a toxic combination that has kept prices on the up. A look at the Fed funds rate and the 30-year mortgage rate over the last 50 years, and it tells the story. Now, some new dynamics are potentially at play. Investors awaiting the Fed's first rate cut, even if minutes suggest it isn't imminent. Either way, the overwhelming tone on Wall Street is that the Fed is done hiking. It comes as U.S. mortgage rates have seen their biggest 4-week slide, with the 30-year fixed mortgage rate tumbling, but still well above 7.5%. Let's put it all together. We want to bring in Mark Zandi, Moody's Analytics chief economist. Mark, you're the perfect person to talk to about this because the economy is certainly tough to figure out, obviously, when you take a look at the dynamics that are at play right now within the housing market. The fact that we have seen rates at the highest levels that we have seen in decades, yet we don't see this sort of dent in housing. Where are we as we head into the new year, and what the housing market is likely going to look like within the first couple of months?
Well, I mean, housing's taking it on the chin, and particularly demand, home sales. We got a data point, I think 2 days ago, was it? Existing home sales came in at 3.9 million annualized. I mean, that's lower than it was when we were in the middle of the pandemic shutdowns. You have to go back to like the teeth of the financial crisis to find sales that low. And that just goes to affordability. I mean, the mortgage rates at around 7.5%, combined with the high house prices, they obviously surged in the wake of the pandemic, makes it very difficult for people to afford it. They can't, and that's why sales are down. So the only way out of the box, the only way to get sales back up is mortgage rates have to come down, incomes have to continue to improve, we have to avoid a recession. And I suspect we'll have to see some house price declines at some point here. So some combination of all those three things, but that's going to take time. So I don't expect the housing market to come roaring back here, certainly not in 2024. It probably won't be until 25, 26 before we see sales levels that are more consistent with what we've enjoyed historically.
Mark, what about the commercial real estate side of the equation, though? We talked about the fact that this is going to be the next shoe to drop now for quite some time. We haven't really seen that to that degree. Is that something that's still a huge risk to the economy?
It's a threat, yeah, for sure. But you're right, Sienna. It's not been as serious, at least so far, as I think given the fears in the wake of the banking crisis back in March. I mean, prices are down. If you look at off the price for office properties or multifamily towers or retail space, they've all fallen. Depends on the property type, 5, 10, 15, 20%. But fortunately, that has not led to a significant increase in defaults. There's been an increase in defaults on CRE mortgage loans, but not to the degree that it's really undermining the banking system or financial system more broadly. So far, at least, the problems in the commercial real estate market are contained to the commercial real estate market. They've not bled out, and thus the macroeconomy is continuing to digest it reasonably gracefully.
Hey, Mark, Moody's Analytics does some political forecasting based on economic factors. I imagine you're getting into that right about now. Do you feel like you understand what it's going to take for consumers to feel better about the U.S. economy and perhaps translate into higher approval ratings for President Biden? Is it all about inflation? Do they need to see actual falling prices?
Yeah, I was just had a meeting yesterday. We dusted off our election model. We model at the state level, the electoral college level, and produce a forecast of who's going to win the election. What states are going to win, how many electoral votes are going to win, and ultimately who's going to win. We're not there yet. We just dusted it off, so we'll have to get that together over the next few weeks. Probably unveil that in January at some point in time. My sense is the problem here for the president is that, even though inflation is moderating, prices are so much higher than they were a couple, 3 years ago for most everything, but particularly for staples, necessities, food, I saw your statistic on how much it costs to put turkey dinner on for Thanksgiving. Gasoline, that's come back in, but it's still elevated compared to where we were pre-pandemic. And probably the most important thing, rents. I mean, people are paying a lot more in rent. And I just think that's hard for people financially to digest, and it really makes them upset. Even though they have a job, wage growth is improving. Actually, wage growth now is stronger than the rate of inflation, but there's a lot of catch up here to do. My thinking is that, as time passes and hopefully inflation continues to go south, continues to moderate, wage growth kind of hangs tough, we avoid a recession. I think that's the most likely scenario. As time passes, people will start feeling a little bit more comfortable about things, feel better about things. But, it's got to happen pretty quickly because the election obviously is approaching very fast here.
Well, putting aside recession talk for a second, there's been lots of concern in Wall Street, notwithstanding all the talk about a soft landing or even no landing, about rumblings in the financial system, and that the Fed's tightening so far, which has been considerable over the last year plus, might break something. And in your notes, you're warning about the potential for an earthquake, another earthquake in the financial system. We had the mini banking panic earlier this year. What does that look like? And as far as you can tell, we can't predict black swans, but where might that come from?
Yeah, that's the thing that really concerns me. The high rates, higher for longer, putting a lot of pressure on the banking system and the financial system more broadly. I have this image in my mind of the financial system as kind of like this engine that's shaking under the stress of the higher interest rates. It kind of blew a gasket back last March, and the Fed and Treasury kind of put the gasket back in, taped it up, but it's still shaking, and it's going to stay that way until we start to see rates come back in, the yield curve becomes more normally shaped. And so there's a lot of stress. What actually breaks? Very difficult to know. I mentioned just one thing that I'm watching that makes me nervous. It's the liquidity, so-called liquidity in the U.S. Treasury market. The Treasury market is very large. It's getting larger very quickly because of our large budget deficits and debt. But the kind of the plumbing that's involved in making sure that trading is done in a orderly way, so that there's buyers and sellers and they can match up and transact, has not been able to keep up for lots of different reasons. And I worry that at some point, we might see a freezing up of the Treasury market. And of course, that's really important for the entire financial system because everything is priced up. All the securities out there, all these stocks and bonds and everything else are priced off of U.S. Treasuries. And if trading is disrupted there, that's a problem for all markets.
Mark, is the public debt crisis here? Is this it?
We're here. It's one thing when you have very low interest rates, the pressure to do things on the fiscal side are they're much less intense. You don't have to worry about it as much because you're just not adding to your interest expense. But now that rates are up, it's a big problem because debt plus higher rates means higher interest payments. Here's a factoid for you. We're going to be paying soon more in interest expense on our debt than we do to fund our defense budget. I mean, that doesn't make any sense whatsoever. And so we've got to make some changes. And, if you look at current law, if we make no changes in tax policy or spending policy, it's just unsustainable. Our debt load is going to rise to a place where the interest rates are going to rise. The economy is going to cave under the weight of all of that. So we've got to make some changes. So I think we're here. Now, obviously, we're not going to make any changes until the other side of the next election. But hopefully soon after the next election, we get a little bit of clarity around, what voters want, and we can make some hard choices at that point. But we're going to need to do that.
All right, great insights as always. Mark Zandi, Moody's Analytics Chief Economist, and Yahoo Finance's Rick Newman. Thank you.
Take care.
HP releasing its fourth quarter fiscal earnings this week with mixed results, but it sees a light at the end of the tunnel. Although results show weak demand for both PCs and printers, the company reiterating its previous outlook for the fiscal year 2024. For Q4, its revenue declined 6.5%, in line with Wall Street expectations. Now, the tech company is optimistic about introducing its first AI-powered PCs in the second half of the year, 2024. We spoke to Enrique Lores, HP CEO, yesterday, and this is what he had to say about the company's work in AI.
I think we are in a time of incredible innovation. And as a company that believes that technology and innovation are going to create a better world, we welcome the speed at which these things are moving. And we have been watching what has been happening during the weekend. Our expectation is that it will not have an impact in the delivery of the new solutions that we need for next year. And again, we are really excited about the opportunities that AI is going to be bringing to us as a company.
Yeah, it looks like their margins were pretty good. They have a bit of pricing power here, not as bad as feared. I'm just looking at the Wi-Fi Interactive real quick. This is a max chart of HPE. We can also do HPQ, but a lot of sideways price action there in both of these issues, Shauna.
Yeah, exactly. When you take a look at some of the weakness within the report, a lot of it was tied to the business side of things. When you take a look at the weakness in the commercial business, HP sales of computers to businesses slipping just about 11% from a year ago to $6.2 billion. That underperformed those expectations. When you take a look at those headline numbers there, essentially revenue coming in just a bit shy in terms of what the street was looking for. Now, about the improvements next year, we just heard Laura is remaining very optimistic, bullish about those AI capabilities and what is going to continue to drive growth. He does see confidence, or is confident, that the PC market is going to grow in the fiscal year 2024. Comparing that, though, to the street's reaction and what we're seeing play out here from analysts, Barclays out lowering its price target, talking about the fact that the results were largely in line with expectations, but the weakness on consumer print and also commercial PC, one of the red flags, one of the headwinds that continues to face the company, also the broader industry here going forward. But again, when you take a look at some of those longer term charts, 3 months, the stock off just about 6% today, though we're looking at a gain of about 4% in HPQ. All right, Autodesk reporting its third quarter earnings this week, raising its revenue, EPS, and free cash flow guidance. When you take a look at the software company beating the street's expectations, revenue up 10% from a year ago. Not all good news, though, for the company. Total billings falling by 11% thanks to the company's decision to change billing to annually based instead of a 3-year contract that was paid upfront. So we're seeing that work its way through the system. In terms of this release, obviously a huge difference here when you're comparing it to prior years and the results that we have seen in the past. We also, when we point to some of the analyst worry out there from the street, a bit of a similar type of story, I think you can say, in terms of what we saw play out for HPQ. When it comes to Autodesk, some worry here just about managing headwinds going forward. Some of those challenges likely to remain. We have Piper Sandler downgrading the stock to neutral from overweight, citing that tepid growth and disappointing margins, and exactly how that sets up the company here going forward. One of the big reasons why you're looking at the stock off just about 6% today.
Yeah, and I was just cycling through some of those charts. Get back to that in a second. But here's a comment by Citi, rating the stock a buy, price target 261. Autodesk continues to show resilient business trends with a slight beat on the Q3 total revenue, profitability versus free cash flow upside, while leading indicators were mixed. Results show consistency and resiliency against a challenging macro environment. I don't know how many times I've heard challenging macro environment this earnings season, but as I promised, I'm going to go to the charts here one more time on the Wi-Fi Interactive, and just a bunch of chop year to date. Over the last 5 years, I like to do a 5-year chart to see what happened in the pandemic. And like many other issues, it was up and then down after peaking in late 2021. So just following the path of a lot of companies in the industry. All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
This holiday season is looking like it may be a frosty one. Earnings this week showing that they are adjusting their spending in the face of higher prices and putting off some of those big ticket purchases. One key theme from this earnings season, yes, retailers are reporting profit beats, but when you take a look at the results from Target, Macy's, Gap, just to name a few, same-store sales continue to decline. A challenging setup here heading into the end of the year. Here with more, we want to bring in Dana Telsey Advisory Group's CEO and Chief Research Officer. Dana, it's great to see you here. So I'd love to get just your perspective from the retail results that we've gotten over the last several weeks. What does that tell us just about what demand is going to look like this holiday season?
Well, we've certainly seen that in the third quarter. The month of October was weaker than September, and it's choppy in November. The unseasonably warm weather was an impact, but let's also call it what it is. It's the level of demand from consumers, particularly at the lower to middle income tier. With rising interest rates, their savings down from what they were during the pandemic, given no more stimulus that's out there, and the real focus on innovation. Consumers, you can call it choiceful, discerning, careful, cautious. They are more cautious with their spending dollars, and to get them to buy, it has to be something different and unique. So I think it's going to be a cautious season. That's why the 3 to 4% holiday season sales gain that we're looking for this holiday season seems more likely. It's below the trend average, what typically is nearly a 4% increase. And with Christmas falling on a Monday, delay is what consumers can do if they think they're going to get a better deal.
And Dana, with all that caution, how is that translating into the luxury side of the market? For all the talk of the Magnificent Seven in the U.S., we had another Magnificent Seven in Europe. Those stocks kind of fell off over the last few months. What is the status of the luxury segment, and what bodes for the Christmas and holiday season here?
The luxury segment has seen moderation too. We've definitely seen European locals slow down their spend. You're not getting the rate of international tourism from those from China, and it's been softer. I think the only ones that have really held up well, it's the Hermeses of the world where prices doesn't matter. So the uber wealthy can continue to spend, but the upper income is not spending at the same rate. In addition, there's more choice. Experiences versus goods. Keep in mind the Taylor Swift concert this past summer, on average, including the tickets, people spent nearly $1,300. So it shows they'll spend for an experience, not just a good.
Dana, what do you make about what's going on over at Abercrombie? When we take a look at these retailers across the board, there were several things to take issue with or be a bit disappointed when you take a look at these results. But comparing that to what we heard from Abercrombie, it was hard to find any sort of weakness in this report. What are they doing that some of their rivals are not, that's giving them the edge in this environment?
You're absolutely right. Abercrombie's been a pick of ours as a favorite for 2023. And the combination of the work that's been going on that Fran Horowitz, the CEO, and her team have done over the past 3 years, whether it's data and reinventing the brand. Look what's happened. The core Abercrombie brand has become a lifestyle brand. The new stores that they're opening in neighborhoods like in Flatiron in New York City, they're smaller, but they're very productive. You look at Hollister, where it's had its second quarter of consecutive sales growth. She's put the data together of who her customer is, offering them what they want. It's unique, it's different, and it's an environment that people want to go together and shop and convert. There's more to come as some of their smaller brands like YPB and Gilly Hicks, along with the remodelings of new stores and the strength of the balance sheet, give it a path for growth in 2024 also.
So Dana, compare that to what we're seeing play out right now at Gap, because yes, there were some reasons to be a bit encouraged by the results that we are getting. Obviously, the new CEO at the helm, Richard Dixon, in terms of what they are doing to reshape their brand, trying, it sounds like, maybe to take a page out of Abercrombie's book in terms of exciting their lost customer. Are they moving quick enough? And what do you want to see play out in that turnaround plan?
There's been a lot of change at Gap. And keep in mind, yes, it comes from Richard Dixon having just joined nearly at the end of July after having been on the board since November. They put in a new leader at Old Navy last year from Walmart. Keep in mind, when you think about Gap, it has a business with Old Navy that caters to a lower income consumer who's more pressured these days, whether it's from rising rates or you don't have the stimulus benefit. It did improve to a positive 1% comp, the first positive comp that Old Navy has had in nearly 2 years. So could there be the benefit of a trade down of consumers trading down? We all know Gap needs to be redone. Whether Gap needs to be redone in remodelings of the stores or remodelings of the merchandise, there definitely is more to do. And we've seen Banana now introduced home, and Athleta just got a new leader a month ago. It took Fran 3 years to put all this together with her team. Richard Dixon has been there less than 3 months. So more to come.
Dana, we had time for one more here. I want to talk about beauty, shifting gears for a second. We've seen a pickup in the stock prices. Sally Beauty up 23% over the last month, e.l.f. 13%, Ulta 9%. Is this, and for the year, it's kind of been a mixed picture as I'm looking at the Wi-Fi Interactive. You got some big winners, some big losers here. What's your take on the space?
I think beauty is a category that was called out in the third quarter by so many companies, whether it was Macy's, whether it was Nordstrom, whether it was Kohl's. It's been a category of strength. We've had definitely headwinds. I mean, you look at Estee Lauder, who has dependency on China to a great extent. So there's differences happening there. I think the category continues to be in demand. I think Ulta definitely is a winner for holiday 2023.
All right. Thank you, as always, for stopping by. Dana Telsey, Telsey Advisor Group's CEO and Chief Research Officer. All your markets action is ahead. Stay tuned. You're watching Yahoo Finance.
Jeff Bezos is reportedly looking to offload more of his stake in Amazon. The former CEO is looking to sell up to 10 million shares. This is according to a report out from CNBC, which comes after he already shelled just about $240 million worth of the stock last week. Now, Bezos still owns 988 million Amazon shares. That's equal to roughly about 10% stake here in the company. We did see a brief reaction in shares yesterday, some pressure on the heels of this report coming out from CNBC. Of course, the question among the street, among investors, is what this means in terms of the direction, I think, of Amazon. We should be reading in to this move if, in fact, this report is correct at all. But again, we're looking at shares pop just about 2% today. So maybe Wall Street shaking off any of those initial concerns.
Yes, and the truth is we're really not going to know why he's selling the shares unless he announces it, because that's not part of the disclosure requirements. And in fact, if you just, I was looking at his share sales to date, and it's quite a laundry list. They're very periodic. I should point out, too, that when insiders are selling shares, it can be for a variety of reasons, and they have to disclose that, and so that's what makes the headlines. But is it significant? We don't know what his planning purposes is. Sometimes it's for tax purposes, and as long as these sales are made with an arm's length understanding that Jeff Bezos himself is not controlling the timing, he can do anything he wants. There's a lot of leeway in these agreements that allow people to sell their shares without being directly accountable for the timing of it. And that kind of relieves them of any responsibility with respect to insider trading or, anything like that. So this is a very regular occurrence. And then, also we have Jack Ma in the news. It was reported that he was selling some shares, and that actually caused quite a big stir because he hasn't reportedly sold any in years. But I want to point out, China is a totally different market. He went missing a few years ago after he was trying to spin off Ant Financial from Alibaba. That was its own drama. So what Jeff Bezos is doing has no parallel really with the Jack Ma experience, in my opinion.
Yeah, certainly. We're getting the reports here from Bloomberg that he reversed his plan to trim the stake after Alibaba shares tumble. So we will continue to track both of these. We'll keep it right here on Yahoo Finance. We've got all your market action ahead. Stay tuned. Welcome back to Yahoo Finance Live. I'm Shauna Smith alongside Jared Blickery. We're just about 30 minutes into the trading day and taking a look at where things stand right now. Stocks are still moving to the upside as traders digest earnings from Nvidia and more developments in the AI space when it comes to OpenAI and Sam Altman back as CEO.
And let's take a look at some of the individual movers we're watching today. Nordstrom saw sales slip 7% in the third quarter, but it reiterated its full-year outlook. The department store echoed similar sentiments from other retailers about the state of the consumer and demand concerns as well.
An Urban Outfitters is seeing strong sales at its Free People and Anthropologie stores, but they did warn of, quote, slight moderation in demand starting last month in October. Same-store sales for the most recent quarter did rise over 5% from a year ago. It was driven in part by strong demand through digital sales.
And Virgin Galactic Space getting hit with a downgrade to underweight from Morgan Stanley. The analyst writing that with the pause in space flights to save cash, there are, quote, limited opportunities for share price acceleration during this upcoming lull period.
All right, we want to get to some breaking news on consumer sentiment. The latest reading from the University of Michigan. This is the final reading for the month of November, falling for the fourth month in a row to 61.3. That was up from the prelim reading of 60.4. When it comes to some of those expectations, the index here, the expectations index falling to 56.8 versus 59.3 the prior month. We know, Jared, that obviously consumers faced with persistent higher inflation, obviously really affecting sentiment right now. We're seeing it play out even this week from some of the retailers, although that is backward looking. The pressure that higher prices has been putting on consumers, and we're seeing that reflected in terms of their outlook here as we look ahead towards the end of the year.
Yes, and the key numbers for me are really in the inflation expectations. There's the Federal Reserve talks a lot about what the expectations are or what are anchored for the average consumer. And we're seeing that elevated right now. So if you, with the one-year outlook, that ticked up to 4.5%, highest in months. So it's going in the wrong direction, which is up. That means consumers are expecting more inflation than they were last year. And then on the 3 to 5 year look, it's up to 3.2%. That matches what we saw last month, but that is a cycle high. That is the highest number since 2008. So I think the Federal Reserve and Jerome Powell are probably looking at this with maybe one raised eyebrow. I don't know about two, though. So on Tuesday, minutes from the November Federal Reserve Committee meeting confirmed that officials are committed to staying the course, but carefully on any future rate decisions. So while consumers appear to be pulling back from buying and inflation cooled slightly, what can investors expect to see from the Federal Reserve as it continues to look out for signs from the consumer and from businesses about the condition of the economy? Let's bring in RBC Capital Markets Head of Rate Strategy in the U.S., Blake Gwynn. Blake, thank you for joining us today. I was just making some comments on the inflation statistics from the report we just got. I don't know if you've had the opportunity to read it, but in general, what is the bond market reflecting in terms of inflation expectations of the general public?
Yeah, at least from the market side, forward inflation expectations are pretty well pinned. We haven't seen any kind of troubling, uptick. The other thing I would point out, I did actually get a chance to just real briefly look at the numbers you were citing on the University of Michigan survey. But, we're getting some kind of mixed signals because I think if you look at the New York survey, for example, of consumers, they don't have that same kind of uptick. Now, there may be a little gap in between when they do the survey period. But it does seem to be something that we're seeing on that University of Michigan side a bit more than either the market measures or what's priced into inflation markets or on the New York Fed's consumer survey.
Yeah, Blake, when you take a look at this consumer sentiment report here from the University of Michigan, obviously pointing to signs that consumers are still a bit worried about what the inflation picture is going to look like here as we look ahead to 2024. But when you take into account the cooling pressure that we have seen on prices from the last CPI print, we certainly started to see maybe a shift in sentiment from investors following that report. Also, what we saw play out in the labor market most recently. How is this affecting positioning into year end and then looking ahead to 2024?
Yeah, I mean, I think, for most of the second half of this year, we saw this very large sell-off from July to October. I think, that really had two pieces. I think there were a lot of concerns around Treasury supply and demand. You may have heard of this term premium conversation, but the other piece of that was that we had very, very hot data for a good chunk of the second half. I think that really culminated in September. We had a very hot, if you remember, very hot NFP, then a CPI print, retail sales, and it kind of capped off with that GDP, very strong GDP report we got at the end of that run. Since then, I think we've gotten some signs that things are cooling. The NFP report obviously came in a bit softer. We had a few weak ISM prints. But I think the CPI print, seeing that go down the way it did, and not only kind of miss where expectations saw it, but it's also just much softer outright. I think that's a pretty important pivot point. And I think whereas that July to October period, markets really had this kind of bearish lens that they were looking at the markets. They were always looking for a reason to get shorter, and I think people were very slow to take off those short positions. And at the same time, people who wanted to buy treasuries and get long the rates markets were very, very hesitant. I think this kind of flips that narrative a little bit. And I think into year end and into 2024, the markets are going to be looking at things through a much more kind of bullish rates lens. They're going to be looking for dovish Fed speak. They're going to be more attracted to weak data prints than they are to strong data prints. The one thing I've said about the CPI report is when you got that softer CPI report, it does change the context of the way we view the data over the next month. Because I think if that had come in on expectations or, even a beat, if we had seen a bounce in the December data, it'd be much easier to look at that and think from the Fed's perspective and say that's a very worrying trend, that we're seeing some signs of acceleration. But now, given that we've had this low CPI reprint, if we bounce back in December, it mostly just looks like noise, and I think they can write it off relatively easily.
And Blake, when we consider what investors are looking at and pricing in next year, we've actually seen more rate cuts get priced in, 4 to be exact, over the last month, and that's up from about 3. And I'm looking at this and thinking that's not always such a bullish thing. Rate cuts generally mean an easier Fed, but it can also be a sign of distress. And we know that when the Fed finally sees a hard landing, it goes from soft to hard landing. It's in an instant, and you see the Fed cutting 100 basis points, 200 basis points at a time. What do you see in the expectations for rate cuts? Anything that might give you caution, or is this just overblown?
No, you mentioned the pricing back in of rate cuts since that CPI print. And as you mentioned, we've priced in about another rate cut into 2024. I very much agree with that price action. I mean, we have long been of the view that the Fed starts cutting in the middle of next year. Where I think we're a bit of an anomaly is that we are not in the hard landing camp. I think most of the times people associate the Fed cutting cycle, as you said, with some type of harder landing, the Fed really kind of reacting, being forced to react to the economy, starting to move into that recessionary territory. We see it a little bit differently. I think I think the Fed in this in this cycle is going to have room to be a little bit more proactive. I think the balance of risks around the economy are going to start to shift. Inflation continues to come down as the labor side of their mandate starts to get a little bit more worrisome to them. I think they'll have a lot more latitude to kind of proactively start to shave back the amount of tightness that the rate environment is currently providing for the economy. So this isn't a very reactive, sharp cut back to accommodation. It's really just kind of removing a little bit of the restriction piece at a time, that they've delivered to the economy over the last year in this hiking cycle. So it's really just more of a correction that we're seeing rather than kind of a hard landing. And the other thing I would say is that paring back of restrictiveness may help kind of elongate that soft landing and really deliver that soft landing and keep the economy from tipping into recessionary territory for a little while.
Blake, how much deterioration or weakness do we need to see in order for the Fed to feel comfortable, like you're saying, and make that first rate cut?
I think the bar is actually a lot lower than some people might expect. The reason I say that is because if you think back over the last year and a half, the Fed has really only had one mandate. There are dual mandates, central bank. They have to worry about labor markets and inflation. But really over the last year and a half, we've been near historic lows in the unemployment rate. All they've had to be concerned about is, are we going to see a, inflationary spiral kind of kick off? You hear Arthur Burns and Volcker invoked a lot, the 70s type of inflation. So that has been their entire concern over the last year and a half. But with inflation very convincingly, I think, on a downward trend, pulling closer to target, even if it's not quite at target, you get to start looking at things through a much more balanced lens. And I think that's why in 2024, I think the bar is much lower, because if inflation is at least moving in the right direction, it gives them that latitude to be much more reactive to even small bumps. On the labor side, they could be more reactive to geopolitical events. If we were to see banking stress like we had last March kick back up again, they have a little bit more freedom to react to that by, not cutting to zero, but saying, hey, maybe 50, 75 basis points of cuts will help get us through this, or make sure that this doesn't tip in, to a harder landing.
All right, Blake Gwynn, always great to get your insight. Thanks so much for having on with us this morning. RBC Capital Markets Head of U.S. Rate Strategy. Thanks, Blake. Keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned. We'll be right back.
HP Inc. out with earnings, and well, earnings were in line, revenue down a little bit. Let's really dig into the outlook for the company here. Enrique Lores, CEO of HP Inc. Always great to see you. Thanks for giving us some time here on this. So take us through the quarter a little bit. Inline earnings. I think there were some concerns on the street on how this quarter would pan out. How did you see it?
I think it was a good, solid quarter. We over-delivered versus some of the expectations. We grew EPS 10% year on year. And the most important thing is showed the progress we have made through the year. This was a tough year from a demand perspective. We have managed the business well. We have managed our cost structure. We have grown share, especially in the categories of PCs where we wanted. So really, we finished the year in a strong position, which gives us confidence for fiscal year 24.
Let's look at the sales by segment here. So you look at the personal systems business, PC revenue down 1%, commercial down 11%. Is the worst behind HP in terms of PC demand?
I think it's important to look at sequential sales and sequential revenue. We grew PC sales 5%, company 5% sequentially. We saw growth, sequential growth on consumer PCs, which is what we were expecting. We also saw stabilization in sales on the commercial side quarter over quarter. So second half has been stronger than the first half. And as we shared a few weeks ago, we expect to grow PCs and the overall company in fiscal year 24. And this moment, the results in Q4 supports the momentum that we start seeing.
What's your best approximation, Enrique, on how the holidays might play out? We're getting a lot of mixed reads. On one hand, Best Buy, squishy quarter, some weakness on some of those bigger ticket items, and Abercrombie & Fitch, good quarter from them on apparel that isn't cheap. I mean, how do you see it?
So what we know is we have, based on the shipments we have made and the innovation we have introduced, we have a very strong position in the stores. We have great assortment. And when we look at the projections of 24, we are expecting the market to grow, and Q1 will be the first in which this will start happening. So we expect progress between Q4 and Q1, especially in terms of momentum.
In terms of growth for next year, Enrique, is part of that growth these AI power computers?
Some of it. The key drivers of growth for PCs next year, first of all, is going to be the replacement and the renewal of the install base, driven especially by the transition from Windows 10 to Windows 11. So this will be a major factor. Second factor is going to be an increase of average selling prices, similar to what we have seen during this year. And finally, especially at the end of the year, the impact that some of the AI PCs will start having in the market. But AI PCs will be a great driver of growth in 25 and 26, but because of when we are launching in 24, the impact will be more modest.
So for an investor trying to figure out when these AI PCs launch, because I've heard some other players, some of your competitors talk about them too. Do they launch at the end of calendar 2024 or is it calendar 2025?
They will launch in the middle of 2024, let's say in the July, August timeframe, which is what we shared 2-3 quarters ago when we started to talk about them. But there is a difference between launching and penetration of new categories always takes time. Our projection is that the penetration of AI PCs will be between 40 and 60% 3 years after launch. And they will have an impact on average selling prices between 5 and 10%. And it will happen gradually, some in 24, more in 25, and more in 26.
So this is just my consumer mindset or consumer hat sneaking on me here. How much is an AI PC, how much is that going to cost? And then what will it be able to do?
So let me start from what will you be able to do. What you will be able to do is run locally large language models, which means that if you want to use private data you don't want to upload to the cloud, you can get the power of the language model using your local data. That will be a big advantage. Also for applications where speed, latency is critical, you will be able to run those applications locally. For example, in gaming, many of the new games will use generative AI. You will be able to run the game locally and have the advantage of the speed. And finally, for many customers, there will be a big advantage in cost. Running AI applications in the cloud is fairly expensive. Running them locally will be just the cost of the PC. In terms of pricing, what we have shared is that we expect average selling prices to be between 5 and 10% higher. And this gives you an idea of the additional cost that AI PCs will have. But let me tell you, the value will be much higher than that.
You know, the printer business continues to be under pressure from a top-line perspective. Is there any AI potential boost there, or you're just managing this business now, taking cost out of this business and acknowledging that sales will be tough for a little while?
Within the print business, there are multiple segments. There are categories that are declining, like home printing, printers at home. There are categories where we expect the market to be flat, like printing in the office. And there are categories where we expect to see significant growth, like industrial printing. And when we talk about our strategies, we need to differentiate our strategies for the 3 segments. Our expectation is that the print market, because of the combination of these 3 segments, is going to be flattish in the next years. And our goal is to grow profitable dollars in the category by managing the different categories in different ways.
So the sales declines, they're noticeable in the earnings release, but the margins, the operating margins of your business continue to hold up well. We've talked about this a lot. Why is that happening, and can you continue to do this throughout next year?
Well, we launched an aggressive future-ready plan to really address our fixed cost structure, and what we are seeing in our margins are the results of this work. We announced a 3-year plan. We are going to continue to execute that plan. We increase the target that we have mostly driven by AI and additional actions in several businesses. So we just increased the margin expectations in our print business, and we expect to be within those ranges in the coming years.
It's a company that really is going to play a key role in this AI ecosystem. I'm sure you're watching what's happening with the Sam Altman and the Microsoft drama. I mean, as a leader of a company that is going to play in this ecosystem well into the future, do you have concerns on how fast these AI companies are moving with this technology?
I think that we are in a time of incredible innovation. And as a company that believes that technology and innovation are going to create a better world, we welcome the speed at which these things are moving. And we have been watching what has been happening during the weekend. Our expectation is that it will not have an impact in the delivery of the new solutions that we need for next year. And again, we are really excited about the opportunities that AI is going to be bringing to us as a company.
You think the tech industry has put in the proper guardrails for this technology? A lot of people barely even know what this is, but it's coming at them, and it seems to be coming at them very quickly.
Well, you know that we really position ourselves as a purpose-driven company, and security and protecting data of our customers is one of our key areas of focus. And we want to make sure that as AI grows, all these data keeps being protected. And this is one of the areas where we are really going to be driving and pushing, because we think it's important that this happens.
Lastly, Enrique, it's the end of the year. We're starting to focus on the year ahead. As a leader, what's the biggest priority for HP looking out into next year? Is it capitalizing on AI? Is it finding more ways to improve costs? Is it improving the supply chain further? Where is your head at?
I mean, we need to work on all these fronts, but if I have to highlight one, it needs to be about continue to bring innovation to the market. AI is one of the elements that we are going to be driving, but when we look at the growth opportunities that we have, we see opportunities to grow by driving innovation in all of them. We are going to continue to innovate in hybrid systems and hybrid work, continue to innovate in our service-oriented businesses, driving contractual, driving subscriptions, and of course, with AI, we can not only create new categories, but improve significantly the experience of our customers in our current businesses.
Thanks to HP CEO Enrique Lores and, of course, our executive editor, Brian Zazi, for bringing us that interview. Let's take a look at crypto prices. We're keeping a close watch after the founder of Binance, CZ, pled guilty to money laundering violations. Another stunning blow to the crypto industry. Jared has a closer look at some of the movement that we're seeing play out within the crypto space. And Jared, despite all this, Bitcoin pretty much holding on here.
Yes, I got to say, this could have been worse for especially CZ, but also the entire industry. They could have had an FTX moment, and they are avoiding. Looks like CZ is going to avoid jail time. So just take a look at what's happened to Bitcoin, the poster child for crypto. Let's take a look at the 5-day price action. Not a whole lot of variance and wideness in the swings here. So this was digested pretty easily. I do want to show, for instance, the Binance token. That's, as you would expect, also seeing a little bit more motion and activity. That's down 7% over the last 24 hours. Here's what's happened over the last 5 days. Let me put this in context of a year-to-date chart. And you can see, although we got some fireworks down here, doesn't even compare to when we were at the highs last year. So really a whole lot of nothing. If you could call $4 billion in penalties nothing. Just taking a look at some of the other elements of crypto. This is what crypto stocks are doing. More red than green today. Galaxy down 4.5%. Looks like Riot Blockchain down 2%. Marathon down 1.8%. But just getting back to crypto, I just want to show some of the movement that we've had over the last month as a number of key overhangs have been taken off the table, potential overhangs. One of them would be Binance, and that was a really big one. But we also have some other things going on. We got Bitcoin, that spot ETF. It looks like Gensler finally allowing that to go through, even though he technically has to comply with the appeals court. It looks like the SEC is just not being as heavy-handed as they were. FTT token. Guess what? FTX going to be a viable entity once again, and so we're seeing interest in that. Let me put a line chart so you can see. We've had some fits and starts with the FTX token here, but now it has really taken off. Has it reclaimed its former glory? Absolutely not. It's still almost by the very lower end of that range, but kind of gives you an indication of the perspective here. So my big picture take here, crypto is being reborn. Looks like we are in a crypto spring with the crypto winter in the rear view mirror.
We will see whether or not that continues to be the case here. Hey, Jared,
Yes.
thanks so much for breaking that down. We're going to take a quick break. We've got all your market action ahead. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
This week, Stellantis announcing plans to build an electric vehicle battery plant within Europe. Now, the plant is being built with China's CATL to build low-cost EV batteries, being the most expensive component in electric vehicles. Could we see more of this type of move going forward? Now, according to Goldman Sachs report this week, we're not too far off. The bank is forecasting EV battery prices to fall within the next 2 years. For more on that, we want to bring in Pras Subramanian. Pras, when you take a look at this report, I guess how much relief could we see in terms of battery prices and what that timeline looks like?
I think overall it's good news for an EV market that's sort of seeing some lagging demand here because of prices or whatever. Goldman predicting that these battery prices will fall by a massive 40% by 2025 compared to 2022. The cost improvements coming mostly from the cathode part of the battery, which is primarily the lithium oxide side, the lithium side, which, we saw soaring prices in that material last year, 2 years ago. That's going to come down. So, for example, the standard battery pack, around 60 kilowatt hours, will usually cost around $9,900, $10,000 in 2022. That'll come down to around $5,900 by 2025 if Goldman analysts are correct. Furthermore, the savings will sort of mean that those savings will come down into the actual cost of the cars by 2025, making them on parity in terms of costs with traditional gas-powered cars. Goldman saying, quote, that the battery cost reductions could lead to more competitive EV pricing, more extensive consumer adoption, and further growth in the EV battery TAM. We love TAM, that total addressable market.
All right, Pras, I'm an investor. How do I capitalize on what Goldman is recommending here and what it sees on the horizon?
So there's several ways to sort of play it from the Goldman's point of view. You have the storage market, which is companies like NVCool, right? And then on the battery cell maker side, you have companies like LG Chem, LG Energy Solutions, and Samsung SDI. These are separate companies than these large Korean multinationals. These are their battery and chemical and energy sort of plays there. And then in next gen batteries, you have BYD and Union Energy. Interesting enough, Jared, they are actually sort of not hot on one of the biggest names earlier was QuantumScape, the solid state battery manufacturer. They said they might have some free cash flow problems, so they're not telling investors to buy QuantumScape.
All right. Thank you for that report. Yahoo Finance's Pras Subramanian.
Thanks.
Crude oil prices plummeting today again, and just days before the OPEC Plus meeting was supposed to take place. It was delayed. Saudi Arabia's dissatisfaction with other members' oil production levels pushed the meeting to next week. This is according to a report by Bloomberg. Now, Goldman Sachs is predicting a 35% chance of additional OPEC Plus output cuts to keep the price of Brent crude falling below $80 per barrel, and that's their estimate. What can we expect from the OPEC meeting? Scott Bauer, Prosper Trading Academy CEO, is here to tell us more. Scott, thank you for joining us here today before Thanksgiving. As we were talking about OPEC Plus, supposed to have a meeting. The joint ministerial maybe got in the way. What are you reading in the tea leaves here? What do you think is going on behind the scenes?
Well, it certainly seems to me like the dissension amongst the members of OPEC Plus is there, and that dissension probably stems from some of the members not wanting to continue cuts because they want to get market share back, and B, led by Saudi, wanting to extend those cuts, perhaps, much deeper into 2024. So, I think they're buying time to hash that significant, piece of the puzzle out before they get together. So the market is looking at that, obviously, with this dip that we're seeing today around 4% or so. The market's looking at that as, there are members here that maybe want to pull back on those cuts.
So when we talk about what the downside could look like here for crude, we're looking at 5 straight weeks in a row potentially of losses. Right now we're sitting just below $75 a barrel. How much downside do you see from here at these current levels?
Yeah, I don't think we can, really trade much lower than the 70, maybe 68 number or so, because you got to keep in mind, that the U.S. government is out there, and they will be resupplying or hopefully reloading up on the SPR. They've already said that, initially that 68, 69 area is somewhere that they want to start buying crude. So I think at least in the short run, that's pretty much the limit to the downside here. But fundamentally, if we look at a bigger picture, it's a different story. Right now, the outlook, the demand outlook is not very strong, not just here in the US, but globally, specifically in China. You know, the narrative, the rhetoric has really shifted from the post-pandemic reopening where, you know, there was all of this intent and all of this forecasting for major demand. That has come down quite a bit.
Scott, just want to shift gears a second to another commodities market, namely gold. We've seen that flirting with the 2,000 level quite recently. And on your screen here, I do have a 1 month look back on our heat map, and I'll see if I can find gold here. But in the meantime, what's your outlook here? We've seen a number of analysts say, well, if it punches above 2,000, and here we have that chart, well, then it can get to 3,000. But that seems to be a real sticking point here. It's just camping out at those highs.
Yeah, you know, there's a lot of push and pull here. Number one, obviously the geopolitical events, you know, is keeping a tailwind, if you will, behind gold as that flight to safety. But on the other side of things here, if you continue to see the dollar soften and if you continue to see rates come down, that could provide a big tailwind as well for gold. So that really could catapult it. I don't know about 3,000. I think 2,100 is really in the sights here. I think we'll learn more at the next Fed meeting, which is only about 3 weeks away. You know, we got Powell's speak yesterday from the minutes from last meeting, but I think we're going to see more. And if it is still a dovish outlook, and if the bond market continues to rally and yields come down further, that is going to provide these tailwinds here. And I think we could see 2,100.
Scott, getting back to what you were just saying a minute ago when it comes to crude prices, what's the impact then on gas prices? Because yesterday we spoke to Robert Sinclair of AAA. He's the Northeast Senior Manager there. He'd said that through a survey, $3 a gallon is still the pain point here for consumers. We have seen pressure on crude prices. Is that going to push gas prices, do you think, below $3 a gallon?
Well, so there's a little bit of a disconnect because we have seen pressure on crude. We've seen, you know, supplies actually ramp up. But for gasoline distillates and supply in gas, it's not the same as crude right now. There has been more of a demand there, and those supplies are not there. And that's why we're kind of holding levels that we are in gas prices. Now, they are down significantly from where we were just a month ago. I know where I live in the Chicago area, we're paying about $3.30 a gallon or so. But you would think those prices would be lower with the big dive that we've seen in crude, but we haven't seen that because those inventories are still pretty low in gasoline distillates, and the demand for gas is still there.
Yeah, the current average here nationwide, just right on actually similar to what you're paying, $3.28 a gallon. All right, Scott Bauer, always great to talk to you. Prosper, a Trading Academy CEO.
Thanks you so much.
Keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back. Black Friday and Cyber Monday are just around the corner, just a few days away. Deloitte is predicting that Black Friday and Cyber Monday spending will average about $567 this year. That's an increase of 13% from a year ago. Now, Penney is out with a Make It Count report showing that consumers are thinking twice here before spending, carefully creating a budget ahead of the holiday season. We want to bring in Mark Rosen. He's the CEO of Penney, alongside Yahoo Finance's Brooke DePalma. Mark, it's great to see you, and thanks so much for taking the time. I know it's certainly a very busy time of year for you. I'm curious what you're seeing in terms of consumer spending trends. Are you seeing consumers pull back yet?
So I think what we're seeing as we've gone into the holidays, we launched our Black Friday early in the month of November. We launched November 3rd through 5th, and we had a really, really successful Black Friday launch. And what that told us is that consumers are looking to have a holiday this year, and they're looking to celebrate with their families. And we saw great traffic increases in our stores and really, really strong engagement. Since then, we've continued with our Black Friday, and we'll continue through the weekend and through Cyber Monday. And we're seeing that customers are continuing to come online and in store. We are seeing a little bit more behavior where they're looking and a little bit more skeptical about some of their purchases. But when they find the great values that we have, and we're committed to provide those great values for our customers, they're shopping and they're buying.
Good morning, Mark. Do you think that consumers are waiting until this week to find the best deals, or have they already completed their holiday shopping based upon the deals that they've seen so far?
I think there's still actually a lot of holiday shopping to be done, and I think it's actually going to continue probably beyond this weekend and into the month of December. Like I said, we saw some really good interest in our early deals, and as we come back with Black Friday deals, consumers have been shopping again. We are seeing them look a little bit before they're buying and being a little bit more conservative on price, but JCPenney is really, we are committed to showing our customer value. We have hundreds of items that we have kept at the same price or lower price than last year. And we're really committed to taking inflation out of the holidays for our customers. And when they're seeing that value, our customers shopping and buying.
And Mark, just to take a step back, we know that JCPenney's core customer is working families. Can you break down some of the headwinds that they're up against the most right now?
Sure. I think, when you look at our customer, they are facing inflation right now. We know that for our customer, they're actually in their household, they're seeing that versus 2 years ago, they're facing bills that are $700 more a month than they were facing before, whether that's fuel prices, rent, or food. And that's a challenge when you're living on a $75,000 median household income, which is our customer base. At the same time, like I said, they are absolutely committed to having a holiday, and we're committed to helping them through that. And so some of the things that we're trying to do to help them through that, for example, is starting December 1st through the 24th, for customers who spend over $250 in store, we'll be offering 6 months interest-free with 6 equal payments during those 6 months. And what that's going to do is let our customers, be able to get what they want for the holidays and take a little bit of the bite out of what they have to spend.
So, Mark, it sounds like some of the consumers that are under pressure, they're still making some room in their budget to spend for the holidays. But looking out to 2024, what does your promotional activity look like, given the fact that your core consumer is likely going to remain under a tremendous amount of pressure?
Yeah, I think our consumer is under pressure, but they're absolutely looking for value. And so our commitment to our consumers is that we're going to provide them great merchandise at great values. I think right now, if you look at the merchandise assortment we have, it's things like our St. John cable knit sweater for women. It's $9.99. St. John's Bay flannel shirt for men. It's $11.99. And when customers are seeing great value like that, they absolutely they want a gift, they want things for themselves, and they have that need, and we're seeing them spend. So our commitment is back to what I said about, the inflation beating prices, that we have hundreds of prices that are the same or lower than last year. Our commitment is to continue bringing that great value to our customers through next year, because that's what they're responding to.
So, Mark, it sounds like you're confident then that spending is going to continue, what you're seeing in this holiday, into the first quarter of next year.
Look, the customer is going to continue to have holiday. The customer is going to continue to, have all of these needs. I think they're looking to do it for less and in a more efficient way. And that's exactly what we're here to help them do.
And we do know that nearly half of shoppers are using credit card rewards to shop at JCPenney's this holiday season. But are you seeing your consumers maybe have a harder time paying off those credit cards beyond this payment plan that you have?
Yeah, I think as we look at credit trends and things like that, we have not really seen a significant change for our customers. So our customer is continuing to pay their credit cards, and we continue to see a healthy customer there.
Mark, when it comes to some of the partnerships that you have made, we had the CEO of Circuit City on the show recently talking about the partnership that Circuit City has with JCPenney. I'm curious from your perspective, why was that partnership appealing to you, and what do you expect to see in terms of the traction there?
Yeah, I think for our customer, what they're looking to find is great items at a great price and a great value for the customer. If you look at that category in electronics, those are things that we don't normally carry during the course of the year, but they're great holiday items and great gifting items. And so it was a great opportunity for us to take a great, a brand that our customer knows, put it together with our brand and bring the customer a great value.
All right, Mark Rosen, great to speak with you, CEO of JCPenney. And of course, our thanks to Brooke as well.
Thank you.
Are you heading to the movies this holiday weekend? For many families, this isn't an ongoing tradition, but the box office has failed to regain its foothold on a once busy time of year in the wake of COVID-19. But what will this year bring? Yahoo Finance's Alexandra Canal has the details. Allie.
Hey, Jared. And that's right. We've yet to see this juggernaut box office since before the pandemic in 2019. And that's due to a variety of factors, from the content pipeline to the hybrid streaming releases, where consumers realized, hey, I don't need to go to the theaters to watch these films. But flash forward to today, and the box office is trying to revive itself. We've seen hints of that with the summer, the Barbenheimer success, and other tentpoles outperforming. But at the same time, we've also seen some serious underperformers, particularly from Disney. And Disney is looking for a big win here with the debut of its animated film, Wish. I spoke earlier this morning with Box Office Pro chief analyst Sean Robbins, who said the number to watch here is in the 40 to 50 million range. If this film is able to reach that, we could consider that a win for Disney, especially under the circumstances. It's also a film that could play the long game here with audiences over the next few weeks, especially since we haven't seen a ton of family-friendly content out there. So perhaps an opportunity for Disney to capitalize on, but there's no denying that Disney has struggled. I mean, this is a company that debuted Toy Story, Frozen, Frozen 2, all over Thanksgiving weekend. And those films in particular really helped drive the Thanksgiving box office to 250 million or more in that weekend alone. And then if you take a look at last year, Disney's animated film Strange World, massive bomb, just 18.5 million. Even in Encanto the year before, Thanksgiving weekend 2021, that only secured around 40 million. So if Wish underperforms here, it's going to be a further sign that Disney has its work cut out for them. Iger has consistently stressed quality over quantity. He wants more wins versus simply more films, but that's all going to come down to strategy in terms of the marketing, creative, and execution of these films. So Disney, a big studio to watch this weekend. Also Apple, they'll be releasing Napoleon in theaters after debuting Killers of the Flower Moon last month. This is obviously a much more adult film compared to Wish, so won't be too much competition between those two movies there. And then with the Hunger Games prequel still in theaters, perhaps the Thanksgiving weekend can reach 150 million or more at the box office. That really has yet to happen post 2019. So we'll see at the box office, and really Disney in particular can bring back a little bit more of that magic this year.
Ali, you mentioned some of the success or maybe lack thereof that we could see this weekend, what that would mean then for Disney's strategy going into 2024. I'm curious what you see the strategy being overall here. When you take a look at the studios, obviously they were able to end the strike here. Good news in terms of releases. How much delay are we likely to see? And do you expect any sort of shift in strategy as they do struggle to get even more people back into the theater?
Well, the strikes is a great point, Shauna, because a lot of the momentum that we've seen from the Thanksgiving box office in the past has happened because the fall slate had been so strong. And because of the strikes, we saw that Dune sequel from Warner Brothers be pushed into 2024. So not as much momentum here as we had previously. Obviously, the fact that the strikes have ended, that's a huge win for the studios, but they still have seen major movie delays. There's some films that were pushed into 2025. So the pipeline has always always been a critical piece of that story. And particularly for Disney, analysts that I've spoken with have said they really need to program things strategically and get those bigger sequels, get that Frozen 3, Frozen 4, which Bob Iger said it's coming eventually, get that into the schedule and really pack in those types of movies so that you could lift those box office dollars that way. So I do expect Disney to focus more on those types of films that are going to be the blockbuster for them for that period of time, whether that be in the summer, which is always a lucrative time for theaters, or the fall. And again, Bob Iger stressing quality over quantity. There's a lot of oversaturation after the debut of Disney Plus, especially in terms of Marvel and Lucasfilm, some of those Star Wars content. So I expect to see a lot less of that and a lot more maybe animated films or just more targeted films when it comes to some of those big franchises that Disney has.
All right, lots to consider there. Thank you for that, Ali Canal. All your markets action ahead. Stay tuned. You are watching Yahoo Finance. Coming up in the next hour, the AI divide and reunification. Just 5 days after a surprise ousting, Sam Altman is back at the helm of OpenAI. But what does that mean for the industry as a whole? From regulation to what happens next, Rochelle Akufo and Akiko Fujita, they have you covered in the next hour. You won't want to miss it.
Certainly won't want to miss that. Let's take a quick look at the markets here. Just about 90 minutes into the trading day. Jared, you were just talking about OpenAI. Well, the AI hype really driving some of today's action following the blowout quarter that we got from Nvidia after the bell yesterday. We initially saw a bit of a muted reaction, still is the case, but we're looking at all three of the major averages still trending to the upside. You've got the NASDAQ up just about 0.4%. Well, again, keep right here on Yahoo Finance. Rochelle Akufo, Kiko Fujita have you for the next hour special on OpenAI and Sam Altman's return as CEO. We'll see you Friday.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo with Akiko Fujita. Welcome to our special, The AI Divide, where we'll break down the tumultuous few days for Sam Altman and OpenAI.
Well, Sam Altman, you've probably heard that name a lot in the last year. His company OpenAI dominated the headlines this week after he was fired from one of the most influential startups in the history of Silicon Valley. OpenAI has been the driving force behind generative AI, the technology behind the controversial chatbot ChatGPT. Now, OpenAI didn't invent artificial intelligence, but it did put it on everyone's radar. The organization began as a nonprofit. Its simple stated goal back in 2015 was to, quote, create safe and beneficial AI through a deep understanding of the potential risks and benefits. Now, balancing those risks and benefits has been a matter of hot debate from Silicon Valley to Beijing and beyond. This week, the story boiled over in spectacular fashion. Altman's exit was a big deal. After all, he'd become synonymous with a sweeping global movement. The reasons still are not clear. Officially, the board said he was not consistently candid in his communications, but the bigger narrative suggests there was a division over the speed the company was going and the direction it was taking.
That's right, and reportedly orchestrated by OpenAI's chief scientist, Ilya Sutskever, the move, which he now says he regrets, has been described as both a tragic miscalculation and a messy coup. Now, in the days that followed, Microsoft, by far OpenAI's biggest investor, staged a coup of its own. They hired Altman. Now, he quickly reposted a tweet from CEO Satya Nadella simply saying the mission continues. Microsoft was certainly on one. The tech giant may be the old guard, but OpenAI was more than just an appendage. In short, it seems the two companies really need each other. Microsoft shares jumped in the aftermath, and in the hours that followed, hundreds of Altman's colleagues petitioned to join him. They wanted the board out, or they were heading out. Well, they got what they wanted. Less than a week after he was pushed out, Altman is now back at the helm of OpenAI, alongside co-founder Greg Brockman and a new board of directors, including former co-CEO of Salesforce, Brett Taylor, and Larry Summers. Now, the appointment of the former Treasury Secretary has certainly raised some eyebrows. So where to now? Is it a win for OpenAI, for Microsoft? Will Satya Nadella's tech giant look for full control? What about Altman himself? Will spend the next hour asking these questions and more? Well, to that point, let's get to you, Akiko.
Enthusiasm and investment around AI largely drove the market's gains so far this year, and OpenAI's revolutionary ChatGPT product helped ignite the whirlwind hype. But what is this startup behind the revolutionary technology? It's unique in many ways, perhaps most notably in its unusual corporate structure.
That's right. OpenAI began as a non-profit dedicated to advancing artificial intelligence to, quote, benefit humanity as a whole. In the pursuit of more capital, the company formed a for-profit entity back in 2019, keeping that non-profit board at the helm. The board can act as it deems necessary to protect the mission of the company, like dismissing the CEO. With Altman back in the role and new faces on the board, what does this mean for the future of OpenAI's mission and artificial intelligence as a whole? We're joined now by Amy Webb, Future Today Institute founder and CEO, and Sinan Aral, MIT Professor of Management, Marketing, IT, and Data Science. A big welcome to you both. Sinan, I want to start with you here because people are trying to separate the chaos from the company and the technology. How should they be viewing what has really transpired over these last 5 days?
Thank you for having me, and happy Thanksgiving, early Thanksgiving. I think your summary is very good. I think the OpenAI entity, which began as a nonprofit and then evolved into a nonprofit and a for-profit whose profit was capped, underlies a specific debate that is much more general to AI, which is the debate between safety and concerns for guardrails and developing the technology in a way that reduces harm and risk on one hand, and corporate innovation that is basically focused on developing technology as fast and as efficiently and as widely distributed as possible. And I think that's what you saw boil over on the weekend. There are some reports about individual, debates between personalities, but I think that at the end of the day, the structure of the nonprofit, the company, and the direction of the technology, and where Sam Altman wanted to take it, much more innovative, much more quick, much more widely distributed as fast as possible, which is probably also in part what Microsoft is looking for with their investment. And the debate between that and the need for slow, safe development of AI is what you saw boil over on the weekend.
Yeah, Amy, let's pick up on that point, because if you look at what transpired late last night with the new board makeup, with Sam Altman being reinstated, it certainly feels like on first glance that the side about entrepreneurs driving the guardrails and driving the innovation has kind of won out in the debate, at least within OpenAI. How do you see it?
Well, I think there are two key points everybody should keep in mind. And the first has to do with calls for safety and regulation within the company. You know, we saw a lot of that over the past year. It's not the first time we've seen CEOs of enormous tech companies going to Congress and other places around the world asking to be regulated. I am sure that there are some folks who are concerned about the development of the tech inside. A lot of this had to do with setting a strategic roadmap for the future for how to develop that technology. But really what this points to is a serious and salient question we need to start asking around those companies that are developing transformative technologies and how they are governed and managed. The bottom line is that this was a 6-person member board that was very inexperienced, and a 3-headed executive management team that was really caught in the middle of developing technology using basic research and then taking investment. At some point, investors expect a return. So the first point here is, if we expect groundbreaking technologies to be developed, we should be taking a much finer look at how those organizations are managed. And then the second point has to do with where that investment comes from. The United States has stopped funding basic research in critical technologies. Therefore, there will always be a tension between investment in building these critical technologies and investors, I think rightfully so, expecting some type of return. If we don't like the situation that we're currently in, then we need to seek out funding in different places. This is the bottom line.
Amy, on the issue of governance, how do you think these companies should be governed? Do the additions of Brett Taylor and Larry Summers on the OpenAI board, does that make you feel any more comfortable with what they're developing?
Well, on the one hand, it does. I think you want mature board members and mature governance because boards really aren't there for the most part as window dressing. They do serve a strategic purpose, and that board's number one priority should be strategic foresight, which is helping the company figure out where do they play and how do they win, but making sure that the public good is front and center, as well as safety, and thinking through long-term implications of the decisions that are being made. But the other thing is that we're approaching AI in a punitive way with regulation. That hasn't worked so far. Regulation is really hard to enforce because it is inherently a look back versus a look forward. The better way forward is to use an incentive structure that compels, in a financial way, companies to make better choices. This is something that has never been tried in the United States before, and I really do think the events that took place over the past few days shows us that we need a different approach going forward.
And Senan, to Amy's point, when you look at the size of the people who are making this decision, this small board here, and you think of the mission of democratizing advanced AI, not wanting it to be in the hands of just a few, does this now fly in the face when you look at the kinds of investors who are really leading the charge here with OpenAI?
Well, I mean, I think that this board is not going to remain 3 members. This board is going to expand to a larger board, a much larger board. I think it's already been clear that Greg and Sam will not be on the board. I think those are concessions that they made upon the deal to come back. And who will be on the board and what the fine-grained details of the board structure will be remains to be seen and is very important. I think 2 things to keep in mind here that are optimistic about the future with regard to these types of technologies is first that safety and profits are ultimately in the long run aligned. So OpenAI does not remain long-term profitable to its maximum potential if it creates safety risks that become public and apparent and create damage and difficulties for the company downstream. But that requires a long-term view. It requires a view that sees developing safety as part of the profit incentive of the company looking long-term. The second thing is democratization is also in line with OpenAI's profit incentive, because ultimately it is a much larger pie if OpenAI is built as a platform company. a platform ecosystem where lots of other third parties can partake in value creation and value appropriation. One company doing it by itself is never going to compete with an ecosystem that has many different players contributing to that ecosystem. We've seen this time and again over the last 2 to 3 decades in tech, and I think this is not something that neither of these 2 points are lost on any board member that would join OpenAI. So I think that there is room for optimism in aligning the incentives, but I agree that these things must be thought about, both in terms of the corporate board structure and its decisions going forward, but also in terms of regulation. You saw President Biden's executive order on AI. It was big and it was bold. The details of enforcement and how that is actually laid out and enforced are really important, and demonstrating that an alignment between corporate innovation interests and government regulation, as well as safety, is crucial.
Amy, do you agree with that point, that safety and profits ultimately are aligned? I mean, it seems like the key question is whether, in fact, they move at the same speed.
Right. Well, I think it depends on whose interpretation of safety you're using. You could argue that right now, a lot of the products that exist from our social media companies are not necessarily safe. And if you look at their numbers, they're doing just fine. I think the challenge when it comes to artificial intelligence, which is a field that I've been a part of now for 2 decades, is that the narratives about AI grossly overshadow what tends to happen in practical terms. We've been living with the idea of walking, talking Terminator-style robots and Skynet-style invisible dragnets intended to take all of our jobs and then murder us in our sleep, that the real safety issues, which in many ways are just much more mundane, get overlooked. We've been talking so much about de-risking the technology in grandiose terms that nobody has talked about de-risking management teams, boards, governance. This board is ultimately going to have 9 members to start. At the moment, it's looking a lot like a Davos panel session, which is not necessarily bad. We do want people who have a lot of experience in helping organizations manage through chaos. On the other hand, we don't necessarily have women or people of color. And one of the challenges with artificial intelligence at this point is that we all know it's still quite riddled with bias. So I would argue that you can absolutely achieve a healthy margin while putting a lot of important safety concerns aside for the purpose of growing the company. And I'll just add one last thing. I was with some of the founders earlier in the year, and they were already at that point talking about OpenAI as an ecosystem, as a platform. And again, I'll just highlight, the real relationship that matters at the moment for these AI startups and tech companies is the cloud. One of the things that we're seeing is a race for cloud share. So as the ecosystems get built out, I think a lot of startups and companies that have made investments have to figure out where exactly they are in that value chain. Because if there are too many links away from the places where the decisions are being made, they have very little leverage going forward.
Yeah, all those key issues you brought up, Amy, certainly points to the infancy of the technology we're still looking at right now. Amy Webb, Future Today Institute CEO, and Sinan Aral, MIT Professor of Management Marketing, IT, and Data Science. Good to have both of you on today. Really appreciate the time. We've got much more to come here on our special, The AI Divide. Stay tuned here. You're watching Yahoo Finance.
Boardroom chaos at OpenAI has highlighted the cracks in its corporate structure. But what about Microsoft? Even though Sam Altman is back at OpenAI, the tech giant might still be the winner. Shares of Microsoft spiked during the upheaval at OpenAI. Now, prior to Altman's return to OpenAI, Microsoft inviting the nonprofit's employees onto the Microsoft AI lab team. So is Microsoft on its way to dominating the AI industry? For more on this, Brent Bracelin, Piper Sandler analyst, is here to tell us more. So talk about the strategy here. We saw Satya Nadella voicing his support for Sam going back to OpenAI and continuing to support there. What is the strategy there as to how Microsoft still comes out on top?
Sure. Well, listen, it's been a very busy month with several new product launches, several user events where Microsoft is getting a buy-in for their first mover advantage in AI with really large enterprises. Accenture going wall to wall with GitHub Copilot powered by OpenAI and GPT-4. Large enterprises like Bayer and Shopify that are building their AI interfaces and functionality using Microsoft technology and OpenAI. So it is very critical as you think about Microsoft and this OpenAI relationship, that they have a much better understanding of governance and controls and the opportunity. Things are happening very fast. There's a lot of excitement. Microsoft has this first mover advantage, but we've seen a little bit of risk here surface around the reliance around OpenAI and the structure there. Clearly, I think it was the right move for Microsoft to lend support over a very short period of time when the future of OpenAI was very uncertain. But ultimately, we do think that OpenAI and Microsoft are very, very close partners and will continue to be close partners. And we're certainly happy to see Sam and the team still together with minimal disruption to Microsoft's own AI ambitions.
Brent, with that said, this is a partnership that existed before the upheaval at OpenAI. Did anything fundamentally change for Microsoft over the last 5 days?
I think a lot has changed, right? I think one, it's exposed some additional risk, right, around Microsoft's reliance around GPT-4 and OpenAI, and so I think there's also some risk to the structure of working with basically this leading innovator in AI that Microsoft has put some money into, yet doesn't have a lot of governance and control over. And so I think that's certainly surfacing as something that needs to be addressed. So absolutely, Microsoft's learned a lot over the last 4 days. Investors have learned a lot over the last 4 days. Ultimately, if you put the drama aside, I think this is probably one of the better outcomes for Microsoft, particularly if you see them now start to have a board seat and more say on the governance of this operation going forward.
And what does this do in terms of their leadership position? I mean, we're already seeing Amazon, AWS investing $4 billion into Anthropic, some of these other AI competitors here. Does this perhaps, seeing some of that blood in the water, seeing some of that corporate governance, those issues there, does that potentially narrow the gap?
Listen, I think narrowing a gap in a 4-day period is certainly hard to do. I would just remind folks, we're very early in the evolution of this AI opportunity. We see Microsoft clearly as a first mover advantage here. They have about $2 billion run rate in AI. That is clearly far and away larger than any of their peers. I don't think they're going to narrow that gap in 4 days, but it's something to watch. By no means is Microsoft the only winner here. I think early days internet, there wasn't one winner of the internet. I think they're all going to look at different ways they can leverage this new technology and try to capitalize on it, leveraging their own internal strengths. Microsoft just happens to have a very bold vision of what they want to leverage here, what they want to do. And again, seeing stability at their partner OpenAI is really important.
Yeah, Brent, I mean, going back to what you just said about the risk that's been exposed for Microsoft over the last 5 days because of what you have said is the lack of governance that was at OpenAI, does that force Satya Nadella to maybe diversify a little? I mean, we've seen the close lock between these two companies, but a lot could have imploded if all these employees left at OpenAI.
On one hand, I think investors will press Microsoft to have some sort of diversification strategy. It's natural to have a multi-source relationship on silicon, multi-source relationships for multiple components. So that, I think, is something you're going to see investors lean in a little bit on. But I will go back. If you think about the role of AI and moving quickly, you're seeing Amazon starting to standardize, right, and work closer with Anthropic. Oracle with Oracle Cloud is partnering with Cohere. So I look at cloud and these AI, generative AI, and large language models as peanut butter and jelly. They go together. They're better together. You're going to have to make some choices because there are a limited number of options today. That will change in the next 10 years, but I think it is important to partner, and Microsoft has selected the partner here that happens to be the leader. And I think it's important that they continue that path, but absolutely over the next 10 years, longer term, they're going to have a more diversified strategy.
Well, it certainly helped the stock over the last 5 days. Investors happy about that. Brent Bracelin, Piper Sandler analyst, good to talk to you today.
Thank you.
We've got much more on all your markets action ahead, along with our special, The AI Divide. You're watching Yahoo Finance. OpenAI's ChatGPT took the world by storm a year ago and saw a flurry of tech companies eager to partner with the startup. Earlier this month, OpenAI reported 92% of Fortune 500 companies are currently using its products, with roughly 2 million developers building custom uses on its platforms. One company is Appian. The software company automates business processes for its clients, and several of its system services integrate ChatGPT. Appian's founder and CEO, Matt Calkins, joins us with more on how he's been viewing the chaos that's played out over the last 5 days. I'd imagine, Matt, that you've sort of been watching from afar, maybe a little nervous to see what's going to happen within OpenAI, but how have you been making sense of what has transpired over the last 5 days?
Yeah, now, of course, I'm watching it from the outside. I'm not on the board, not inside these discussions. But what it seems like is we've just had a breakdown, a kind of a governance failure, a different point of view between management and the board. And I can totally see how this happens. You know, in our industry, the software industry, we've got a lot of talented, essential, and sometimes unpolished people. And the board's job is to educate, not necessarily to discipline, but to try to smooth the edges without killing the golden goose. I started Appian when I was 26, and it's possible that I tested the patience of my board a few times as well.
So when you look at the current board makeup now, some of the names that are still being thrown out here, does that make you feel better about this issue of balancing the risks of AI with also the growth of the technology?
Yeah, well, I do think that we have a chance to restart now. OpenAI, I don't think this weekend solved any of the problems. Whatever problems existed there, we've still got them, but we have a chance for a reset. The issues are on the table, and I think we've got the best possible way now to address them in a professional manner. So that's good. It does really say something though about this industry. OpenAI is a flagship in AI, and we've had a close glimpse inside of how they work in the past few days. We see they're less than 1,000 people. We see that they've got this kind of a disagreement, this conflict between the board and the governance, that maybe nothing's perfect. It's really interesting to see what an absolute leader in AI looks like right now. And I think it's a signal to the rest of us that this is a growing and not necessarily a very mature industry in a lot of ways. This is what the bleeding edge looks like.
Matt, it's tough to believe that it's just been a year since the world has been introduced to ChatGPT. But talk to me about how Appian integrates OpenAI's technology and why that was a partnership that made sense for you. Has that idea shifted?
Yeah, it's been just a year. It's amazing. I think it was a year ago today so that broke out. We use OpenAI thoroughly in our product. And speaking not just for Appian here, but for our industry generally, the combination of generative AI and process automation is a beautiful thing. We could take a form and turn that form automatically into an application, collecting all the data, routing it to the right place, handling it like a case. It's amazing what you can do when generative AI is turned toward building a process, not just textual output. We also use it as a co-pilot to help you develop applications. We use it as a way to query vast volumes of text in order to understand their meaning quickly. The marriage of process automation and AI, specifically OpenAI's generative technology, has been extraordinarily productive.
But Matt, when you have a visionary CEO who literally the workforce is willing to move with him if he was going to move, if the board didn't get its act together, what does that mean in terms of the potential for perhaps diversifying or even developing your own in-house that doesn't rely on ChatGPT and OpenAI?
Well, look, as much as I admire what OpenAI has done, I think it's essential that every organization diversify their dependence on AI. You've seen here that these organizations that create the very cutting edge concepts are fluid, right? That they're subject to change. And so at Appian, we have partnerships with many AI providers, and we use the technology from many of them in our product. I think that's just prudent for any organization that's making a big bet on AI today.
And Matt, there's certainly a debate that's happening within AI about whether, in fact, this should be open source, whether this should be developed privately, how much transparency should exist. Kind of talk to me about how you're thinking about it and how you've kind of shifted, or whether, in fact, you have, as a result of what's played out at OpenAI.
Yeah. All right. Well, the privacy question comes down to safety. And I think a lot of the reason why a lot of people want to get inside how AI is being developed is because they want to be sure it's kept safe. And I understand that had something to do with this weekend's events as well, concerns about how worried we all are about safety. I think that the proposal to have the government look into red team data that came out of the White House a couple of weeks ago was a constructive first, very, very small and not particularly effective step, but it's a step. I think the main way we're going to keep this safe is not by forcing it to be closed, right, or forcing that there be no open source AI, but rather by regulating the data on which AI is trained. That's the key lever, and I'm surprised to date to see how little regulatory attention there is around this obvious avenue. The way to keep AI safe is not by limiting who can do it, or who can see it, or who can use it, but rather on what data can be trained to create these AI models, right? If you don't want it to be used to make a dangerous weapon, then you don't train on weapons data. If you don't want to make a new virus, then don't allow it to be trained on viral data. If you don't want it to discriminate, then don't allow it to be trained on data that could create bias. If you don't want people to lose their rights over their own privacy, their copyrighted information, then forbid AI from being trained on that data. I think we're missing a big opportunity here in the regulation of AI to regulate it based on the data that can be put into the AI system. I don't think there's a perfect answer, and I don't think anybody's come up with a really credible way to keep AI safe per se. It's just too powerful for that. But I do think that we should be focusing on what data goes in.
On that point about regulating data, who should be driving the conversation? Is it entrepreneurs like Sam Altman, or should it be up to lawmakers in D.C.?
It should not be entrepreneurs like Sam Altman, and it should not be big tech. And I think that big tech has far too large of a voice today in the regulation of their own industry. You can see this in the White House resolution that came out recently, where the obligation of AI is merely to anonymize the data, the personal data that they're training on. That's not nearly enough, and that doesn't defend the rights of the people who create information or who are worried about their own privacy. We should instead expect the government to take the lead and to protect people protect creators, protect people who own information and who are worried about their privacy. And that is not in the best interests of the people who create generative AI. They want to take every possible data they can get, every information, they will take copyrighted information and train on it if you let them, and private information as well. And I say we should stop letting them. The government needs to take the lead. Industry doesn't want that.
But Matt, is it actually possible for the government to take the lead when this technology is still in its infancy, as we saw the mistakes that were made in regulating the technology surrounding social media companies, that now policymakers are trying to put that genie back in the bottle? Has the horse already left the barn at this point?
No, it has not. No, there's still an open issue as to whether AI is allowed to be trained on copyrighted information. And if it is, then who owns the creation that AI could later make with reference to that copyrighted information, right? There's a lawsuit out there with a couple hundred authors signed on saying AI got trained on their works and now has knowledge of the works that they shouldn't have and can therefore create new works in the same style. And that's an infringement. I believe it is an infringement. I think that this is going to come to the judicial system immediately, and it might as well come to our legislative branch as well. We need to think about who owns what data and whether AI use of that data is an infringement.
We know we certainly haven't heard the last of that. I'm sure more lawsuits, as we've also seen with musicians as well, coming to the fray. Appreciate that breakdown. Yes. Matt Calkins, Appian founder and CEO. Thank you for joining us this morning.
Thank you.
All right, we'll have more on our Yahoo Finance special, The AI Divide, on the other side of this break. Stay tuned. Altman is back as OpenAI CEO, but the mood has shifted. Investors are keeping an eye on the broader landscape as governments lag behind the evolving tech, from Biden's new executive order to the EU's AI Act. So what's next in the road to regulation? Let's bring in former FDIC Chief Innovation Officer and Duke Professor Sultan Megji and Axios technology reporter Ashley Gold to discuss more. Thank you for joining us this morning. Sultan, I want to kick things off with you. What does this open up for regulators? We essentially had what could have been an acquisition without an acquisition if Altman had stayed at Microsoft. What do you think regulators will be focusing on with this wake-up call?
Oh, this is an incredible issue, right? Because one of the things we're struggling with on the regulatory side is understanding the impact of AI and how to keep the centralization issues that happened with social media, that happened with 5G, that happened with cloud, and now with broader big tech issues. This just looks like another way to get past the regulatory landscape. There are a lot of conversations here in DC about, well, we didn't have that issue this time, but what if this had happened? And so it absolutely will be on the minds of regulators.
Ashley, what are you hearing from your sources about how lawmakers, policymakers who have been trying to come up with some kind of framework for these guardrails, how they've been watching these developments?
Absolutely. So in Washington, it's Thanksgiving week and lawmakers tend to be a little more quiet during that week. I was hoping to talk to more of them over the weekend. But what we heard specifically from Senator Mark Warner and a couple others is that this turmoil at the top of OpenAI just goes to show that there needs to be rules of the road from the government in place to make sure AI is safe for people and is working for the best of humanity, no matter who is at the helm of these big companies. The lawmakers like Sam Altman. He's made a good impression on them in his trips to Washington. But, this shakeup is quite telling that maybe at the top here, there's disagreement over how far this technology should go. And I think when Congress ramps back up after Thanksgiving, we're going to be hearing a lot more about that.
And Ashley, on that point about what this policy could look like, there's a few templates on the table, right? There's the bill from Josh Hawley, Richard Blumenthal. There's also the executive order that's on the table too. Where's the consensus right now? Is it about transparency? Is it about sharing, sort of the red teaming? Like where are you hearing about where this is likely to go and likely to pass?
So I would say that there is still not a ton of agreement on the broad contours of AI regulation, but where we are seeing some agreement come up is transparency. Like you said, people want explainability. They want to know how these algorithms work. They want to know when what they're seeing is generated by AI versus a human. So that transparency part is something that everybody agrees on. There's also agreement that only the sort of biggest, most complicated, most dangerous advanced models are the ones that should be highly regulated. There is a sense that smaller AI companies that are doing AI models that aren't quite as impactful should not be caught up in the same regulations as these foundation models that OpenAI and others are working on. So I think that's a bit of a lesson we learned from the social media era, that it is not one size fits all when it comes to regulating technology, and companies of different sizes have different needs. So there's a lot of discussion about sort of the right sizing these regulations.
So Sultan, to that point then, should it be about a large framework that sort of oversees everything, or sort of building on the existing laws to protect when it comes to the sort of data that's being mined, consumer protection? Is that a way to sort of stay on top of it as the technology itself races ahead?
Now, given the likelihood of Congress passing anything reasonable is somewhere between 0 and a negative number, we're going to have to make use of the existing laws and the existing interpretations. The challenge is they're exclusively based on risk, right? And they're not based on the capabilities or the impacts. And so it's sort of like saying I have a regulation that works on a fax machine, therefore I'm going to apply it to email. It probably is good for the next year, maybe 2 years, but at some point Congress will have to start doing something to actually pass laws. The other challenge here is that foundational model is kind of a misnomer. There are dozens of companies that are very small, that are not publicly traded, that don't sit in front of the White House, that are fundamentally reshaping, for example, biotechnology or the markets. And so this notion of a framework based on size or scale of AI model is not going to work in this case, because the most impactful artificial intelligence companies aren't the ones in the news this week or last week or even for years. And so the way that it's being thought about, even inside of the regulatory frameworks, is going to miss a lot. And we're going to see issues over the next few years without a more comprehensive set of laws passed by Congress.
Sultan, when you think about these big tech names, you mentioned Microsoft, obviously been in the headlines, but Google, I mean, they have been under scrutiny from regulators for other issues, antitrust specifically. Microsoft, yes, they were under scrutiny for the Activision acquisition, but they've largely escaped some of that, partly because they've been in close conversation with these regulators. Yeah. I wonder if you think what has transpired over the last 5 days, that puts them right back in the center, the crosshairs of regulators, because in many ways it points to the sheer scale, the power, the money that Microsoft has in betting on this very technology.
Absolutely. I mean, Microsoft has put just $10 billion into OpenAI and has the ability to fundamentally change what the board decided in 5 days with a couple of phone calls. And I think it does reframe how a lot of people are going to think about this. And whether it's Microsoft in particular or the big tech companies writ large, we're going to be in a situation, I'm positive, where the output of the last 5 days of chaos at OpenAI will fundamentally shift the regulatory lens back to the big tech companies that are writing these checks. And now, coming out of this process of 5 days, previous to this, Microsoft did not have a board seat. They were not even board observers at OpenAI. It's very clear that they will. And so now there's a new regulatory concern. And I think an antitrust discussion is going to end up happening no matter what.
So Ashley, if we're going to end up having this antitrust conversation, then what does that mean for some of these innovators? As you've mentioned and Sultan mentioned, it's a lot of these smaller innovators flying under the radar who perhaps aren't catching the eye of regulators. So how do you think regulations will proceed from here? What are some of the most promising legislations that you're seeing?
So in the past couple of years, we've had Congress making a valiant attempt to update the antitrust laws for the digital age with the American Innovation and Competition Online Act, a couple of App Store bills. Those bills made it pretty far in Congress, but they did not make it over the finish line. Where we've seen most of the action has been in the courts and in the federal agencies. You've got ongoing tech antitrust cases at the Justice Department and at the Federal Trade Commission. The Federal Trade Commission has promised to look at OpenAI as well. So I think, like the other panelist was saying about Congress moving very slowly, that where we're going to see the most action is in these federal agencies and in courts. We have to see who ends up filing a lawsuit. And that is where we're going to see most of the action when it comes to antitrust in the coming years. I think that we're shifting toward a world where the antitrust laws will be updated for the digital age, but it is very slow going.
Sultan, we haven't necessarily talked about sort of the VC side of things. I mean, part of the what happens at OpenAI was, on the one hand, you had a nonprofit structure, but you had a for-profit arm where plenty of VCs were pouring in money there. Do you think that continues? You think they move forward a little more cautiously? I mean, give me the pulse on that, because you've got a good vision on that side too.
I think for the last, let's say, 12 months, especially since the release of ChatGPT, there's been this gold rush, or view of a gold rush in the venture community, investing in kind of anything and everything. I mean, a few years before that, we saw the same group of people investing in organizations like FTX, kind of, enthusiastically, but not too thoughtfully. I would hope that a lot of the venture capital firms out there that are investing are really getting back to basics and saying, is the thing I'm investing in structured the right way? Does it have the right governance model? Does it have a board of directors that's a credible governance mechanism? Do they have product? Do they have algorithm? Do they understand the regulatory landscape? Do they understand these various discussions that we're having here? And I think we're going to see an evolution away from, these massive checks for PowerPoint presentations, frankly, turning to something that's a little more meaningful. We're also in an interesting cycle, as we've seen over the last few years, where there are a lot of venture firms that are going off to raise right now, and their investments may or may not have shown promise or shown any sort of delivery. Most venture firms, even if they say they're 6 or 7 year funds, really are trying to get exits within 3 years. So if you're investing in something that's a PowerPoint presentation, you've got to get out of it in 3 years to give your investors their money back. you're not in a situation where, you can really trust that the market inertia is going to take that value up now. You're in a situation where it comes down to basics. Are they selling? Are they making money? Do they have sticky customers? The normal, I'd call it bread and butter of venture capital. So I think there is going to be a change. And I think as we get into next year, I think raising for artificial intelligence is going to be a lot harder. It's going to be based on revenue. It's going to be based on technology. It's going to be based on governance.
And Sultan, just to quickly follow there, obviously some of the legislation that we've seen has been in reaction to developments from countries like China and their high tech in this space as well. Could that be what tips perhaps some sort of consensus in Congress to when they see that perhaps this is something they need to be getting ahead of as other countries pull forward that don't have that same red tape to get through?
That's a great question. You look at China on one side, which is moving incredibly quickly with very little regulatory input. You look at Europe, which is moving very quickly on regulatory with kind of less AI, and the US is kind of in the middle. The question is going to be, the balancing act between, letting innovation move at the pace of innovation or, slowing it down through some sort of regulatory evolution. And, the US has always kind of lived in the middle of those two worlds. And right now we're seeing that represented politically with one party being very much in favor of one and the other being very much in favor of the other. You can figure out who that is. And out of that, we're going to be in a situation where over the next 12 to 18 months, I'm hopeful we'll get to consensus, but I'm not sure we are because the economic impetus is still on lack of regulation. And that's still what's driving the fundamental investments in AI. It's not government research like it was 30 years ago when I got started. It's fundamentally based on, do you make money? And so then there will be a push against a regulatory solution.
Ashley, this feels like conversations in so many industries. To what extent does regulation oversee the safety of innovation without stifling the actual innovation? How much of what's happening around the world matters to lawmakers? Does that speed things up? Is this kind of a wake-up call, if you will, that they've got to move quicker because they didn't necessarily do that with other issues like social media and crypto?
It absolutely is a wake-up call, and I think you really saw that momentum moving when the Biden administration rolled out their AI executive order shortly before the global AI summit in the UK, where Vice President Kamala Harris was there with Rishi Sunak and other world leaders, and they really wanted to get something out there before the summit to say, hey, here's what the US is doing, here's our approach, and we think it's the best approach when it comes to balancing innovation and also, reeling in the possible most dangerous behavior. And we want everyone to be reminded that the top AI companies are American, and we want them to continue to be supported and grow here and not feel stifled. However, we're still looking out for safety. So the White House has been very careful about sort of towing that line and making sure that message gets across on the global stage. They have indicated that they think the EU has moved too quickly and that they cannot let China be the leader on this either for obvious reasons. So that is the line they've been towing.
Okay, we'll be watching to see how things move from here. Ashley Gold, Axios technology reporter, and Sultan Megji, former chief innovation officer, federal FDIC Duke professor, venture capitalist. Good to talk to both of you today. Really appreciate the time.
Thank you. Bye.
Thank you.
It's been a tumultuous 5 days for the AI space, with Sam Altman's abrupt ouster from OpenAI and now reinstatement. And Rochelle, we've been listening to some of these experts over the last hour. I will tell you, as somebody from the outside looking in, following this technology as a reporter, I'm not sure I walk away from this conversation any more comfortable that things are being developed at a slow pace that ensures the safety of AI, especially after all the warnings that we have gotten from these very founders about the AI's potential over the last year.
And I think that's what it really speaks to, because it's the same voices. It's the Elon Musks, it's the Sam Altmans really decrying the risks of where AI could go, while at the same time pushing for more development. I believe we're now in that ChatGPT 4 or 5 at this point, looking at even larger language models, basically looking at a lot of unknowns at this point. And then you add this shakeup at this company at the center of it all, Microsoft in there, hedging its bets as well. Satya Nadella, at least for now, supporting this move, really playing the long game here. It still remains to be seen how Microsoft is really going to capitalize on it. But it really does speak to generative AI being the sort of battleground in the tech space. Even when you look at some of the investments, you're seeing Nvidia, also one of the big front runners when it comes to investing in generative AI. And we've talked about diversifying in this space. So what this means for Microsoft, for the Googles, for the Amazons. And then something interesting that a lot of guests were bringing up is the partnership between cloud and generative AI. And so you have the opportunity here for even more exponential growth, while regulators still getting caught on the back foot, Akiko.
Yeah, and it's worth sort of taking a step back to explain to those who haven't necessarily followed the story about why there's been so much attention on OpenAI and ChatGPT. I was looking through the numbers here earlier this month. You had Sam Altman saying that ChatGPT had over 100 million weekly active users. So a year on from its release, it is being much more widely used. It's growing much more quickly. And that's why there's been so much focus on that. Regulation is certainly going to be key for this space moving forward. I'd imagine, Rochelle, we're going to be talking about that a lot in the months ahead.
Oh, you absolutely know we will. It's certainly a wake-up call across the bow for the tech space. Well, let's get your final check of the markets as we head into the noon hour. Looking at green across the board, we're looking at about a 0.5% increase there for the Dow, up about 185 points. The S&P 500, they're also up about 0.54%. And looking at the tech-heavy NASDAQ, they're up 0.6%, still riding high after that earnings report, that bumper earnings report from Nvidia, as we stay in that tech space. Well, that does it for now. I'm Rochelle Akufa with Akiko Fujita. Thanks for watching. Stay with us on Yahoo Finance.